have a bar for the parents to sit at to sort of offset the experience of, you know, the screaming, loud, flashing lights.
All of those earnings still coming up. We are at Apollo HQ, and I'm pleased to say that joining us now is Mark Rowan, the CEO. Mark, good morning to you.
Good morning, all.
Great to have.
Thank you for coming.
Great to be here and great to have you with us. So let's just go straight to the top of this conversation. Private markets versus public markets, and why you believe the big opportunity right now is in the former and not the latter.
Look, we've had a sea change, not just over a year, we've had it over 15 years. So much of our public markets are indexed and correlated. 80% of volume S&P 500, 60% of the market ETFs. 100% of our returns this year are from 10 stocks, which constitute 35% of the S&P, that traded an average PE of 50. How many of us come in every day looking to buy 50 PE stocks? Not many. And I guess what I'm suggesting to you is that public markets, they're so correlated and indexed to interest rates and to money flows, that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
Is that not inherently a risk in your mind, liquidity?
Liquidity is a risk to everyone, but in different degrees. So if you are a retirement plan or a retirement system, you know your liquidity requirements for the next 10 years. So if you can get paid for illiquidity, why not get paid for illiquidity? If you're a wealthy individual, how many of them need 100% of their money on Tuesday? If they don't, they should get paid for illiquidity. And we're seeing that in the performance data. If you look at the active management has failed to beat the index 85% of the time for 20 years. And I think it's going to get harder, not easier, to beat the index. As more and more of the market is indexed, very little money is left to actually make up what needs to be done in active management.
What is the single operational distinction between Drexel, Burnham, Lambert, and your Apollo? What is the micro idea you can give us of then versus now?
I'll give you Drexel, I'll give you Lehman Brothers, I'll give you Bear Stearns, I'll give you SVB, I'll give you First Republic. The financial institutions tend to die of one of two causes, heart attack or cancer. Heart attack is funding risk. They borrow short and they lend long. Cancer is the slow addition of poor quality assets, which over time undermine the system. So you look at all of those firms, all of those had an element of both heart attack and cancer. Funding risk as well as asset risk. You look at what we're doing, we are borrowed long and lent long. Everything is matched. Everything is in a fund. There is no daily liquid, quarterly liquid money at Apollo. We are ideally situated to take advantage of less liquid assets. We've structured ourselves that way. And then you look at the totality of what we do. Equity is a risk business. Equities go up and down every day. You can lose money in public equity. You can lose money in private equity. In the credit business, the vast, vast majority of what we do is private investment grade.
When I look at the risks out there and to translate it into Nassim Taleb and all the work he did in quant with Black Swan, what are the tail risks you see right now for private equity? I mean, are you hedged perfectly? Is there next to no delta where you feel so comfortable? Or are there actual tail risks at Apollo?
I don't think there are tail risks, and I don't think there are tail risks in private equity. I think private equity is a risk-taking activity, but each of the companies, each of the situations is idiosyncratic onto itself. And over time, private equity has proven to be a very good asset class, recognizing that in certain markets you will lose money. Just like in certain public markets, you will lose money.
Well, you had a test here with the way interest rates went. You had a 4, 5, 6 standard deviation shock. How did your risks perform given the shock of higher rates? The glide path of that, how was it along the way?
Single best year in Apollo's history. Earnings, asset performance, our platform, if you think about it, we are around $650 billion of assets under management in our asset management business. $500 billion of that is credit. We generally benefit from rising rates. Yes, on the equity side, some equity will be worth less than it was, but as a general rule for Apollo, credit rates going up is very strong. On the retirement services side of our business, which is the Athene business, just gone through the roof. Athene is up 30% year over year
So I'm going to steal a page from this guy because he's been talking about Ozempic a lot. And honestly, I think that it's important for us to talk about.
Are you telling me something that
No,
I need to
absolutely not. And I don't think
You're suggesting that I'm on a Ozempic?
Please continue.
I'm not saying that anyone is on Ozempic. We're talking about this as a game
I wanna
changer
make that clear.
potentially. No one here is on Ozempic, and we're not making any. Not that there's anything wrong with it. Whatever. Let's move on. Here's this question about how much that transforms life expectancy, how much that transforms some of the investment thesis from your perspective and for retirement.
Look, over time, you would expect improvements in healthcare, improvements in health technology to improve life expectancy, but not by all that much. We tend to find other things that are bad for the human body. As one thing does not kill us, another thing does. But I would expect the trend to continue. We are, just to be clear, we are not in the insurance business. We are an insurance company that is in the retirement services business. We make money by guaranteeing people's retirement, and we earn money by earning more on our assets than we pay out on our liabilities. Very little exposure to longevity or any other what you would consider biometric or typical insurance risk.
There's a real question here and a real focus on income, and you've been talking about that, how there is risk in equity, but not necessarily the same type of thing that you see in credit. And we just saw credit outperform private equity pretty meaningfully. Are you going to shift away from private equity more and more and just focus purely on the more credit business?
No, is the answer. But we have to step back and go back to what our business is. Our business at Apollo, and for most people in the alternative asset management industry, we're not in the asset management business. We're in the excess return per unit of risk business. And then I ask myself, where can we get excess return? Well, in equity, we've gotten to 150 billion. Is it going to grow? I think it will grow. Will it grow multiples? I don't think so. I think the nature of the business, if we're true to ourselves of just focusing on excess return, is slower growth. I look at the credit business. The credit business is nearly 500 billion today. We're not relevant. In the scheme and the scale of these markets, 500 billion is not a relevant sentiment. I assure you, when you speak to all the big bank CEOs today, they don't wake up every day wondering what the mighty Apollo is doing.
There's a phrase I've used twice already this morning in the last 40 minutes, 1 hour, debanking. And every time I've used it, I've had pushback around this table. Why don't we like that phrase, debanking?
I personally like that phrase. Jim Zelter it'll cost me $20 for just saying the word debanking, but I'm happy to pay it. I think the world is debanking. And I say it this way. Every economy, every regulatory scheme, credit is tied to GDP. And regulators have only two choices as to where credit comes from. It can come from the banking system, or it can come from the investment marketplace. There's no third choice. And everyone around the globe has made a different decision. But if you look at the trend, with the exception of China, everywhere in the world, regulators are favoring investors over banks. That does not mean we're going to see a sun shift. That does not mean the banking business is going out of business. On the margin, though, the growth is going to take place in the investor marketplace rather than in the banking system for good and valid reasons and for regulatory choice, not because the banking system is unsafe.
So given that, you said you don't see a lot of upside in terms of growth, tremendous amount of growth in the equity side. You said you're relevant with $500 billion. How big, how relevant could you become?
Well, I sat next to a senior executive from BlackRock last night at dinner, and they had food in front of them, and I had no food. And I said, how big do you have to be to get food in front of you? And he said, 10 trillion.
So that's what you're aiming for, $10 trillion?
No,
Is that what you're saying?
Look, for us, this is about excess return per unit of risk. Our business plan calls for a doubling of our business. And at the end of the doubling, liking who we are as a culture, our limiter is not capital raising. Our limiter is not size of AUM. Our limiter is making sure we get excess return per unit of risk, so finding assets, and making sure we like our culture at the end of the day.
Mark, this is great. You're going to stick with us. Mark Rowan, the CEO of Apollo. If you are just joining us, I'll whip through some of the price action for you on the S&P 500 to begin. Equity's shaping up as follows. We are pulling back just a touch on the S&P. We're down by 0.4%. Yields coming in a couple of basis points on a 10-year to 4.2337. The conversation with Mark will continue in the next hour. Just a programming note. John Zito, the Apollo Deputy CIO of Credit. Matt Nord, the Apollo Co-Head of Equity. And Mark Downing, the COO of Athene. There are tons of themes to talk about this morning. TK, the next theme we need to talk about is a really delicate issue in the work that Mark's been doing over anti-Semitism in this country.
Yeah, it's front and center for a lot of people and a huge number of the surveillance audience. It's not just at the fancy schools, it's nationwide.
That conversation is going to continue right here in New York City at Apollo Global Management's headquarters. Looking forward to cover that all through the morning with you. Equities pulling back just a touch on the S&P 500. No real drama from New York City. Good morning.
Connection lost.
DOJ or other authorities.
Good face. Bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
is noise versus signal.
Now, more to the point.
What is the lesson or the observation?
To us, the Jewish people, the rise of anti-Semitism is a crisis, a 5-alarm fire that must be extinguished. No matter what our beliefs, no matter where we stand on the war in Gaza, all of us must condemn anti-Semitism with full-throated clarity wherever we see it, before it metastasizes into something even worse. Because right now, that's what Jewish Americans fear most.
That was Senate Majority Leader Chuck Schumer there, the nation's highest-ranking elected Jewish official, speaking from the Senate floor on the rise of anti-Semitism. Live from New York City, from Apollo Global Management headquarters, good morning to you all. Before we get to that delicate conversation, just an update on some of the price action for you. On the S&P 500, waking up this Tuesday morning, pulling back just a touch by 1/3 on the S&P 500. Coming in, Tom, a couple of basis points on a 10-year, 423.37.
At Apollo Global Management, we welcome all of you right now, Lisa Bramowitz, John Farrell, and myself for a delicate conversation with Mark Rowan, Chief Executive Officer of Apollo. And we all bring to this our childhoods. My childhood was a white Anglo-Saxon Protestant grandmother, John after her third Scotch, who would talk about how Jews couldn't go to a certain school in Massachusetts. Most of them ended up at Lisa's University of Chicago. That was a different battle. Now there is a new battle, and we address this with Mark Rowan. I am stunned at what I see at these schools, and particularly at your University of Pennsylvania. You've been vocal. What is the dialogue you're having right now with the leadership of University of Pennsylvania as they deal with this new anti-Semitism?
There's no dialogue with leadership. At the moment, leadership is on their way or in DC for a series of congressional hearings. But the underlying culture that permitted this to happen is just so strong. And until there is a moment of self-reflection where we're not dealing with just anti-Semitism, we're dealing with the culture that allowed this to happen, there really is going to be no progress. And to date, there's been no progress.
So what is progress, right? Because there's a real question around free speech versus something else. What is the something else that you're looking for some of these universities to target?
It's really not a question of free speech. This is a question of favored speech and disfavored speech, and an institutional psychology and an institutional culture. So there are places where this is modeled and they're getting it right. For instance, University of Chicago. University of Chicago is getting it right. They are kicking Penn's butt, to be candid. And it's not that hard. The institution has decided that it is institutionally neutral and that the students and professors and other actors on campus are allowed to have opinions and to speak their opinions within respectful ways. Say what you will, say what you want, allow the other side to speak. That is a culture of free speech. A culture where you shout people down, where you have 95% of the professor or academia speaking in one way, where you permit violent protests, where students aren't able to go to class because there's boycotts or there's pressure or other things, is not a culture of free speech.
How do you understand the increase in anti-Semitism on the left, which has really polarized, frankly, the Democratic Party and created a lot of sort of soul-searching?
Look, this is a long time coming, but I'll start with history. The definition of anti-Semitism, the modern definition, the IRA definition, includes anti-Zionism as a form of anti-Semitism. This got through the Senate, with many of the current senators still there, 99-0, including most of the most progressive Democratic senators. So what we've seen is we've seen a shift in the mood of the populace, particularly on university campuses. We live in a culture on these university campuses of simplicity. You are oppressed or you are an oppressor. If you are oppressed, it does not matter what you do, you can do no wrong. If you are an oppressor, facts be damned, it does not matter what you do, you can do no right. In that kind of mindset, it does not surprise me that anti-Semitism, anti-Zionism has taken hold. And if you give historical context, go to the Holocaust. You have dehumanization, you have delegitimization, and then you ultimately have genocide. Now you apply that to anti-Zionism. You have dehumanizing of Israelis and Jews. You have delegitimizing of Israeli and Jews. And now with Hamas's attack, you have the beginnings of killings. It's not that hard to see where we are. The only thing that's hard is for the left to recognize it.
I've been surprised that people have been so surprised by where some of these campuses are at. And I think about the amount of tremendous philanthropy that have come from people like yourself over the years on these campuses. I do wonder why we allowed it to come to this, Mark, why it got this far, when we've seen this been building for years and years and years through a whole generation.
The answer, I believe, is a slow build. And it ultimately comes back to governance and leadership. If I speak just about University of Pennsylvania, the governance is actually divided between the faculty and the trustees. Except for the last 25 years, only one of those two groups has been doing their job. And I put myself in the camp that did not do their job. I was a trustee for a long period of time. The trustees have a very important role to play in setting the strategic direction of the university, permissible and impermissible, where we want to go, except it's not a governing body. 47 trustees really can't agree on anything. It's not set up to govern. There's no history of govern. And so in the absence of any leadership, faculty or administration has taken these universities in a direction that the alumni do not recognize. When you have a John Huntsman, a Ronald Lauder, a Cliff Asness, and 7,000 other alumni who, for their own reasons, their own political persuasions, their own belief system, all don't recognize the university that they loved, you have a problem.
So first move is to stop donating, I guess. We could disengage, walk away. You seem to be more constructive about the prospect of change here. You think there is a better path ahead?
I think the worst thing that can happen to these universities is apathy. Right now, there's not apathy. Donors are engaged. They want change. They love the place. This goes on much longer. I think we will get to apathy. And once we get to apathy, I don't think the universities can recover from this. And unfortunately, all university presidents that I'm aware of, particularly at the University of Pennsylvania, they seek to wait this out. Maybe this will go away. I won't have to deal with this. That is actually a loss. They haven't internalized that that's a loss, but that is a loss.
There's an understanding there's a woke adjustment going on right now. We see it in Hollywood, the collapse of many Disney movies and others that have certain messages that aren't selling to the public. The FT has an article on your colleagues at BlackRock on ESG and how there's a woke adjustment in ESG. How's this going to adjust the wokeness of these universities? How will it adjust?
Look, this is a question ultimately of balance. This is not a question of a pendulum swing all the way back. But right now, these universities are out of balance. And I believe that the trustees, the alumni, and by the way, many of the faculty, if we read Bill Ackman's letter yesterday, and the experience I'm having at the University of Pennsylvania is word for word the experience that Bill Ackman is having at Harvard. Professors don't want to be muzzled anymore. They feel that they can't speak out unless they are conforming to the narrative of the university, and the resentment is building. All we've done, all I've done, all Bill has done, is given people an opportunity to speak their minds. And guess what? They have a lot to say.
Big election next year. Let's finish on that. Is this going to change how you approach US politics? Who you would endorse for 2024?
No, it's not going to change.
Do you have a favored candidate?
No. It's hard to believe with 350 million people in this country that we're down to 2.
Are you disappointed with these two?
Personally, I'm disappointed.
What is it about these two that you find so disappointing?
Look, we have the single best hand of cards anywhere in the world. We have it all. We just play this hand poorly.
What does that mean?
Think about it. People want to come here. We have an incredible knowledge base. We have abundant energy. We're leaders in technology. We have a massive domestic market. We're the strongest military power. And yet we have challenges that we have not been able to, as a result of lack of leadership, as a result of political consensus, to address. We have a retirement crisis. We have a healthcare crisis. We have a budgetary crisis. We are inconsistent to our allies around the world. We have important decisions to make without weighing in as to what's going on in Ukraine and what's going on in the Middle East, all of which seems to be caught in a little bit of a morass.
Is United Nations experience important for a presidential candidate?
United Nations, no.
Okay, I was trying to get him to...
That was delicate.
It's delicate.
That was delicate.
That was the sensitive side of it.
I thought I responded delicately.
Yeah, I think that was perfect.
Mark, thank you. Thank you for having us. It's good to catch up.
Total pleasure. Thank you.
Thank you very much. Mark Robin there, the CEO of Apollo. The coverage will continue here at Apollo's global headquarters here in New York City. From New York City, good morning to you all. The price action looks a little bit like this morning. Equities on the S&P 500, slightly negative, pulling back on the S&P by 0.4%. Yields a little bit lower as well. Live from New York City, good morning.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's get straight to it. Here's the price action Tuesday morning. Good morning to you all. Pulling back just a touch, slightly negative on the S&P 500. Likewise on the Nasdaq 100, down 0.5% on the Nasdaq. On the S&P, off by 0.4. Into the bond market, tons of economic data coming up a little bit later. Job openings and the ISM. We'll keep an eye on that. Jobless claims coming up later in the week. And then the big one, payrolls Friday. The estimate at the moment, 189,000 in our survey. The estimate's still pouring in. That number can change. It's drifted a little bit higher over the last couple of days. Yields on a 10-year, 423.18, down 2 basis points. On a 2-year, 462. Almost a double-digit basis point move higher yesterday off the back of, Lisa, I guess off the back of nothing, apart from the move on Friday, which was just in totally the opposite direction.
It was in response to people getting sober and saying, wait, maybe we priced in too many rate cuts given the fact that the Fed isn't changing their signal and that, frankly, the economy is doing better than a lot of people expected consistently. So it seems like there was a reset. Now we're going to be bouncing around traders market because there's no Fed speak to guide us.
We are in the quiet period going into next week. One of us is more disappointed than the other. Bramo would prefer it, apparently. I'm not there with her. The Federal Reserve next week, that decision just a week away. Let's finish on foreign exchange. The euro against the dollar looks a little something like this. The euro pulling back just over the last few days, in and around 108. So get you some news. We can do that right now. Under surveillance this morning, Israel ramping up military operations further into southern Gaza. The latest from a spokesman for the Israeli Defense Forces saying fighting is now house to house and tunnel to tunnel. In comments from the White House, National Security Advisor Jake Sullivan saying the U.S. has laid out the expectations for Israel to avoid civilian deaths and talks to release the remaining hostages held by Hamas continue. A week ago, we were talking about a constructive tone, Lisa, maybe even an extension of a truce. That is not where we're at this morning.
And we've heard that part of the reason why there wasn't necessarily an ongoing hostage release was partly because there was, at least this according to the State Department, Hamas did not want some of the hostages who were released to tell their stories. There also is this ongoing focus to limit civilian casualties. An increasing number of horrific pictures are coming out of Gaza. This is the real question. What is going to be the pressure to resume a temporary ceasefire to get the hostages out? And then longer term, who steps in to create some sort of solution to a really difficult conflict?
That could be the longer term, but it's been a short-term week. And what I find fascinating, and particularly on radio, just looking at the footage that was showed of war underway, you look at Anzio as they were south of, I believe, above Rome, and you look at Anzio as they moved up in World War II. There weren't cameras there with the direct, immediate footage of the challenges the Allies had in attacking the Germans at that time. This is a whole new war. This is brand new, and we're living it, I won't even say day by day. John, I'd say it's a 12-hour window.
To your point, Tom, it's a whole new war. It is brand new. It's only not even 2 months old. And that's why we've stopped focusing on a different war. And the White House and the administration trying to refocus efforts there as well. The White House warning US aid to Ukraine is set to run out by the end of this year. In a letter to congressional leaders, the Office of Management and Budget warning this: we are out of money and nearly out of time. The House Speaker, Mike Johnson, setting up a debate on Capitol Hill, responding, quote, "The Biden administration has failed to substantively address any of my conference's legitimate concerns about the lack of a clear strategy in Ukraine. House Republicans have resolved that any national security supplemental package must begin with our own border." So 2 wars, right, guys? We know where we are on this. On the one side, you've got Israel. There is division within the Democratic Party on how best to provide aid in that war. The other side, you've got a war in Ukraine. There is division within the Republican Party about how to go forward between Republicans and Democrats. We need to address all of this in the new year, on top of potentially big spending cuts as well. You can see we're on a big collision course down in Washington, D.C.
So maybe this is the calm before we start worrying about a government shutdown again, January 22nd, I believe, or
is that
one
the
of the
date?
dates.
I didn't know that.
I will go and just double check that. But there's this question around whether there is a bit more coalescing, a meeting of the minds when it comes to the border issues, given the fact that there has been a lot of pressure on Democratic governors in particular.
John, quickly, I just wonder how much of this is war fatigue from Iraq to Afghanistan, now 2 wars that we're in or not in, whatever it is, where the American public is finding a new form of isolationism to move forward on, and that's part of this debate.
2 big energy shocks, or at least one, and we thought we'd get a second.
Yeah.
And it hasn't happened. And maybe the surprise of this particular war is that it hasn't spread yet. We all hope it won't. And that crude is still in the 70s, both on Brent and WTI. Saudi's energy minister warning cuts to oil production can continue past the first quarter of next year. OPEC Plus deepened voluntary cuts to production after a delayed meeting last week, yet oil markets have failed to respond in a meaningful way. Speaking exclusively to Bloomberg, Prince Abdulaziz bin Salman says the cuts will be delivered and there are no concerns about demand.
I beg to differ with the pundits or so-called pseudo-experts of saying that there is no growth in demand. We see physical growth in demand. We see things that are improving. Even the world economy storyline is not as bad as people are seeing it. But we want to make sure, again, this precautionary approach, which a lot of people are having a problem with me on this issue of being precautious. I'm not a gambler.
I'm not a gambler. I'm not a gambler, is the message coming out of Saudi Arabia, Tom, at COP28, I believe, over in Dubai.
Well, it's going to be interesting to see those themes there, but again, it is a climate conference in the United Arab Emirates on the Arabian or the Persian Gulf, however you want to call it. So, you know, this is different than having a climate conference, pick your city. There's something unique going on in Dubai. We're going to look into that right now. She is in Dubai and not at her Apollo Global Management. Olivia Wassner joins us now, head of sustainable investing for Apollo, again, from COP28. Olivia, thank you so much for joining us. A big splash in the FT is they really go after ESG and say, is this all going to work out? And part of it, and this goes to the investment of Apollo in sustainable investing, it's you can make money at ESG. You can make money and profit with sustainable investing. Is that what Apollo's witnessed with your investments? Have you seen money being made by being sustainable, by doing the things COP28's talking about?
Absolutely. Well, first of all, thank you for having me. Thank you for having me in from Dubai and from COP28. I'm thrilled to be here and also be able to beam into Apollo this morning. Absolutely, that is what we are seeing with our investments. So if we look at the capital we have put to work over the last 5 years into sustainable investing themes, the firm on a whole has put about $31 billion to work. And that was really across the entire platform. That was in real estate, that was in infrastructure, that was in credit, that was in private equity. And all of these deals were done in regular funds. These were done in funds that had return targets, and we saw great opportunities to make money for our investors, to meet the return targets of the funds, while also investing in businesses and in products and projects that are actually very much contributing to the clean transition, the energy transition, how we think about sustainable resource use going forward.
Olivia, if you look at COP28 and on to 29 and 30, are the financial discussions of Apollo and other good and worthies, the great and the good, if you will, are they being overwhelmed by major polluters, the United States and also China, for example, on coal?
Well, so first of all, one of my biggest surprises of COP28 so far has been that it is not all doom and gloom. There is a lot of really good news coming out of COP. You had 120 countries commit to tripling the amount of renewable generation by the end of the decade. That's massive if you think about it. We've had just so many positive announcements around capital going into the transition from all different areas of the world. So one of the things that has really struck me is just the amount of capital that's really being mobilized, the ambitious commitments that folks are really setting here, and how excited everyone is. You know, if you look at historical COPs, as we think about, 28, 29, 30, the makeup of who was here has really changed. So when I was walking around yesterday, instead of seeing just nonprofits and government officials, you see people from law firms, from investment banks, from asset allocators, asset managers, consulting firms. It really is amazing to me just how many people are here and how many people are really thinking about how does climate finance affect what they do? How does it affect their businesses? What are the opportunities that are coming out of this? Both for the financial institutions like Apollo as well as our corporate partners.
Olivia, I've got to be honest. I was surprised also about just the degree of optimism, considering how much pessimism there is around the ability to reduce the increase in the climate by 2 degrees Celsius. Given that, how much are you looking to invest in things like carbon capture and other measures that go against just simply reducing emissions?
Yeah, absolutely. So listen, we have a big challenge ahead of us. And if you look at the amount of capital that needs to be spent, over the next 30 years, it's massive, right? We're looking at somewhere between $5 and $6 trillion a year of capital that needs to be spent. Apollo is very much looking at what we want to do on our end and how we really want to lean into financing this transition. So we've set a couple targets for ourselves. We set a target of $50 billion by the end of 2027. And we set a target of $100 billion by the end of 2030. So for us, we're really looking at big numbers into this space. And when you look at what we've done historically, again, $31 billion over the last 5 years, it has been a tremendous amount of capital. And I talk to my peers here. I talk to financial institutions. I talk to other folks who are here. And what you're really seeing is there's just so much capital really being mobilized here at the corporate level as well. I think the world has realized we do need to decarbonize, and now we're looking at what is the best way to do it and how do we get the right pools of capital into it.
Do you feel that people are losing enthusiasm a little bit? We've seen some of the backlash, and Tom was just talking about how there is this rethink. Have you seen any of that backlash in terms of just a halting in institutional enthusiasm?
I haven't really. Certainly, you read the papers, and there is certainly some backlash. But on a whole, I just think, if you look at the quantum of people who are here, at the number of businesses, at the number of corporates, I mean, there's just so much really good energy around this event. And folks are really looking at, what can they do? How can they do it? How can they best finance it? Where are the gaps? We've had a lot of discussions over the last couple days about the missing middle, right? How do we get to this scaling up part? There's been a ton of capital that has gone into the venture capital and growth equity part of the value chain. And we've got capital that's gone really into the infrastructure. So when you have fully de-risked investments, but how do we find that part in the middle where you've got technologies and companies that are proven, that are working, but that just need a little bit of help to kind of get to the next level. We see that both in individual companies, as well as, it might be corporate carve-outs of much larger companies. It may be green financings for a larger company. There are so many opportunities here to really help fill that gap. And I'm excited about what Apollo's doing here. I'm also excited about what I'm seeing so many of my peers do here.
Olivia, we've got to leave it there. Thanks for jumping in front of a camera for us. Busy day for you over there, I know. Olivia Watson, the head of sustainable investing over at Apollo. If you are just joining us, equity's shaping up as follows on the S&P 500, pulling back just a little bit. We're negative here by 0.4%. I think 2022 and 2023, 2 wake-up calls in 2 different spaces for this effort. I understand there are huge investment opportunities here, but 2022, what did we highlight? Just how fragile energy supplies were in specific parts of the world, Europe, and how we'd neglected to invest in fossil fuels in a sufficient way to make sure we were insulated from that, and the prospect of moving away from these things too quickly. 2023, I go to EVs. EVs piling up on forecourts, Tom. Sellers are struggling to push them to consumers in America. And we're going to see more of this. Now, the question you've got to ask yourself is, do we need to turn the other way, hit reverse, or slow things down? Which one is it? And arguably at the moment for a lot of people, it's need to move more slowly, moving too quickly and exposing ourselves to different things. And 2022 is exactly that.
Especially given the fact that now the U.S. is producing a record amount of oil, which really raises that question. But with the EV, it's a good point, especially with China taking the high ground with that particular.
Should we squeeze in a mover?
Yes,
I know
please.
you want to talk about headlines from JM Smucker.
Yeah. Well, honestly, there is some sort of negative. Full-year adjusted earnings per share came in below expectations of a high of $9.65 versus $9.85. But they aren't seeing a material impact from Ozempic.
Weight loss drugs aren't hurting the company.
I know.
That's the headline.
Okay,
That's the headline right there.
Okay, I
Nothing else
told you. And then
matters.
you
Come
criticized me when I...
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
We still have more and more evidence pointing in the direction of the labor market softening. One indicator, jobless claims, yes, still good. Okay. But basically everything else is pointing in the direction of what you would expect. It's beginning to look more not like a soft landing or hard landing, but more like a long-term landing. We're waiting more and more and more for any evidence of either a sharper slowdown or an acceleration.
It's not a soft landing, it's not a hard landing, it's a long-term landing. Torsten Slok there, Chief Economist at Apollo, speaking to us a little bit early this morning. Tons of fun here this morning at Apollo Global HQ. We've already sat down with Mark Rowan and Jim Zauter. A ton more guests to come this morning right here. Let's start with the price action and look to equities, pulling back just a touch. We're negative on the S&P 500, a little softer to start the week, down another 0.3% on the S&P, down 3 basis points on the US 10-year, TK 422.41 on the 10-year. Lots of data this morning, job openings, we get the ISM as well, then on to jobless claims later in the week, and on to payrolls this Friday.
What's going to be amazing here, John, is the idea of what does a 10-year do? A real stasis there, I would say. Do you agree with me? It's been really, like, last 3 days stability in the 10-year. No, just 3 days.
If you look over the 3 days, I think, sure, but if you look at the intraday moves, we've had like 10 basis points in either direction.
The shock of the nearing jobs report. I mean, what does, given which way we can go on a job report with revisions, do we start talking 399 if we get the Zelter put
you'll get a bump.
It's like the Greenspan put,
because of
it's just a Zeltner
UAW.
put.
So 189 is the estimate for Friday, Tom.
Yeah.
You get a bump from UAW. I understand all of that, but let's just say it's 150, excluding that. It's pretty solid, isn't it? 150, unemployment south of 4%, claims in at around 200K.
We've been asking, what's the bigger surprise for markets, an upside surprise or a downside surprise? And right now, I'm not sure, but either way, we were hearing yesterday could be disruptive to equities in particular because we are in this narrow Goldilocks, what is it, long landing?
Whatever.
It's beginning to look a lot like...
Long landings.
Long
landings.
Yeah, it's beautiful.
That works. That
Thanks.
works.
That was
this
good.
Christmas.
That was really good.
The bet next year, the hope, the dream, is that you get this so-called soft landing. The growth decelerates just a little bit, but not too much, and disinflationary trends continue, and this Federal Reserve will cut. The one thing that's going to spook this and completely mess up the everything rally is bad data. Tom, bad data changes this again.
Thank you.
Not all rate cuts are created equally. If you're cutting interest rates because inflation is coming down and growth's okay, great, fantastic news. If you're cutting interest rates because growth is getting absolutely hammered, completely different rate cut that you've got to deal with.
It's a bad data, but I'm going to go to where it was an hour ago on nominal GDP. It's the bad data that leans into the way we calculate gross domestic product or gross domestic income, and then also at the same time, the calculation of inflation with the oddities of real estate, the goods deflation that people are talking about.
I mean, this to me, going forward, is going to be the key question. At the same time, if we do get good data, is that going to be good news, right? That's really the key question. Bad data is going to be bad news, but is good data going to continue to be good news?
The bad news is investment has failed. We mentioned earlier the Employment Retirement Income Security Act of 1974, and the summary of that historic legislation is, guess what? Retirement in America has been a train wreck. At Apollo Global Management, they're trying to fix that, and they're doing that with Stephanie Dresser, Chief Client and Product Development Officer, for apologizing to wealth management on how are we going to make money if it doesn't work under traditional means, and that's what she does here at Apollo. You have a ginormous challenge, which is active management has failed, period. 493 passive investment stocks have failed, period. So there's got to be an alternative. Give us a window. You're at a table in Hong Kong or Singapore with a high net worth individual. What's the alternative to the conventional failure?
Well, first off, thank you so much for having me here today, and it's great to see all of you. So I was in Hong Kong just last week and speaking to many clients and different platforms. And look, stepping back, you're right. There's only 10 companies in the S&P 500 that have generated 90% of the return. And in contrast, when you look at the total number of companies globally, nearly 90% are private. So to your point of offering alternatives as part of a portfolio construction, the classic 60-40 model has not served the retiree, has not served to generate the type of long-term financial goals that an individual is looking for. So when we think about alternatives, we talk about fixed income replacement, equity replacement, and how real assets can offer that excess return in an environment that is challenging to meet those returns.
Let's build on the fact that you were in Hong Kong. Is a lot of money coming still from China into U.S. private markets as a way to diversify out of that region?
Look, we see our flows coming globally, and Asia certainly represents a meaningful share of the global flows, in addition to what we're seeing coming from U.S. individuals and EMEA as well.
There's been a big push at some private investment firms to create instruments to give access to retail investors. Is that something that you think is a good call, given that a lot of the investments are long-term and a lot of retail investments are short-term, easy redemption types of products?
Absolutely. Look, you need to trust managers that can navigate cycles and be disciplined and rigorous in their underwriting and the downside protection. The benefits to be able to complement a portfolio that has historically been either daily liquid or frankly very long-term in terms of private markets. Right now, individuals have the ability to access a suite of semi-liquid offerings that with a bit more illiquidity allows that excess return, which is critical to build that diversification and allow them the ability to generate the returns that have historically been in the hands of institutions. So if you think about it, the individual right now is meaningfully underallocated to alts in contrast to the allocations that we see with institutions. And the institutions have benefited from those returns and their ability to generate what the retirees need in their plans.
Let's talk about a product, Apollo Alignment Alternatives. Can you talk to our audience about what that is and how big that is now?
Yeah, so it's approaching 15 billion, and Apollo Aligned Alternatives allows, as a strategy, to access diversified private markets exposure. So when we think about the equity markets and the volatility and the concentration that we spoke about, the ability to replace a piece of one's equity, public equity exposure with a strategy that provides broad private markets exposure is very attractive, given the challenges we see going forward.
What's the mix in that fund at the moment? Institutional, retail, what's the makeup of it?
It's both. It's both. Importantly, what we did early on when we looked to develop the global wealth business is we went on a bit of a listening tour to figure out what the challenges were for individuals as they think about adding alts to their portfolios. And we believe this strategy addresses each and every one of those areas of focus for individuals. We wanted to create an efficient access point, one that operationally it makes sense, and frankly from a tax and regulatory perspective. So in each instance, we listened to the needs of the individual and ultimately tailored it in a bespoke way for them.
When you listen to them, particularly internationally, how much do they want to participate in American technology? Are they saying, okay, we'll do that. We're going to throw a pot of money into the Apollo portfolio, but can you also buy Microsoft?
You know, for us, it is diversified across sectors. And when we speak with them, they look to our investment capability. And ultimately, they are looking, for the most part, across asset classes and looking in their portfolios to use alternatives as a tool to complement what they're doing by asset class in fixed income, in equity, in their real asset exposure.
Stephanie, this was great. Thanks for being with us.
Thank you.
Thank you for having us. Stephanie Drescher there of Apollo. You guys are going to continue through the next hour. I've got to run back to the studio.
You're going to miss it.
I'm going to sort of
you just
run
want
through
to
the
go have
cold.
some bacon.
I'm going to run through the cold.
You're going to go in there.
Okay, let me clarify. I'm going to pass by bacon and all of that stuff and pastries, and then I'm going to run to the studio. And that takes about an hour. Okay.
They're close to 7th Avenue, and Mark sprung today, and it's like big breakfast. It's not just Egg McMuffins. I mean, they went large here at Apollo today.
Look at Jean-Georges around the corner, Tom. Central Park South, just on the corner there. Central Park West. You know,
I don't know.
Maybe they'll open for breakfast.
I don't know that one.
No, yeah, of course you don't. Of course you don't. Coming up in the next hour, we'll catch up with John Zito, the Apollo Deputy CIO of Credit, Matt Nord, the Apollo Co-Head of Equity, and Mike Downing, the COO of Athene. On Bloomberg TV in the following hour, Andrew Sliman, Morgan Stanley, Cameron Dawson, New Edge, Wei Lee of BlackRock. Wei Lee coming out with their new outlook, so look out for coverage of that a little bit later on this morning. From New York City, from Apollo Global Management HQ, good morning.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This last month's Fed meeting was really about the market had done the work for the Fed. This month's meeting is going to be about, well, the market undid all that work.
They have a perception issue with Main Street versus Wall Street and making sure that inflation expectations are anchored.
The market has a decent chance of slowing down next year. Does it mean it's a massive crash? No, not necessarily.
Our view still is for a soft landing, and I think that's the challenge for equity assets in particular.
It's not going to be all Goldilocks. It's not going to be easy, but we do think that there is a path for inflation to continue to come down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. On the right side of the tracks, headline, I've gone below 59th Street for the first time this year.
Oh, yeah.
Here at Apollo Global Management.
Welcome.
Jet. Oh, this has been a joy so far, hasn't it, Lisa?
It's been really illuminating, considering the fact that there are these sort of macro trends going on within the industry of shifting to private increasingly, but also this question around where we are at a moment that's pretty uncertain economically.
Yeah, we started strong with Jim Zelter talking about the Greenspan put. It's a Zeltner put is the rename for it, and it goes right into the Friday data here. You know, we're distracted here by finance and credit and investment. Come on, it's an economics week with huge data on Friday.
Yeah, we're going to get the payrolls report, then we're going to get the drumbeat to it with the initial jobless claims on Thursday, ADP on Wednesday. I know you follow that very closely. You care a whole lot. And then the JOLTS figure, which you started the show by saying you don't care. Right? We do get JOLTS today at 10 a.m. I care. I think it's interesting, especially because Torsten Slok was talking about the quits rate. Fewer people are quitting their jobs. So this is a softening. Does this mean that we're heading toward a downturn, or just, I don't know, something that can leave rates where they are for a longer period of time?
Our conversation is so important. We're going to get through a quick data check. Lisa's got 14 questions for John Zito here at Apollo. Right now, let me do the data for you here. And what's great with the distraction of this wonderful remote is we got very quiet markets. SPX off 2 days in a row off the joy of Friday. Euro hasn't moved since time began. 10-year yield 4.22%, giving me no love. And crude, I guess crude is of interest with Anne-Marie Horton with us here with an update coming up. But with the incredible difficulties of the Eastern Mediterranean, that's my surprise of 2023. I would have said $98 a barrel.
Especially given the fact that Saudi Arabia is pledging additional cuts going forward.
Well, that John Frayer interview was something.
So it raises this question, is this because we're seeing demand drop off? Is this because of some of the shifts that we're seeing globally with respect to renewable energies? Or is this something else? Maybe trading volumes, maybe something else going forward.
Right.
But to me, that has been one of the biggest surprises.
One more thing to talk about China, and this is the almost bipolar nature of it. The service statistic out of China, which I really don't understand, full disclosure, was actually pretty constructive, but grim news on their balance sheet on the property side.
And this has been a consistent story. How much is that going to really force their hand to initiate some sort of stimulus, which is the reason why they got downgraded, let's be clear, by Moody's, because they are probably going to have to step in, and that will affect their fiscal backdrop.
Breaking news is 3 p.m. this afternoon. You'll see it. Apollo Global Management buys Shanghai. They're looking for that restructuring here.
And someone's going to do damage control shortly.
This afternoon. Joining us now
To do
is
damage
the
control.
interview that Brammo has been most waiting for. John Zito is Deputy CIO of Credit at Apollo. That's an important idea. And just the vignette here of taking the loyalty program of Air France KLM and saying, we can make this like United or whatever pitch they gave them. They just closed that deal. Is one example of a transaction. Why don't you bring in handsome John Zito?
How brave do you have to be to invest in the airline sector? John Zito, thank you so much for being with us. Deputy CIO of Credit at Apollo. I do want to start there, this idea of direct big investments in specific companies, how hard that's getting to do at a point with pretty high valuations and a questionable outlook going forward.
I don't think 5 years ago many people thought that private credit would be defined as providing private loans to Air France, Vonovia, AT&T. I for sure did not think that that would be happening, and it's happening pretty quickly. I think what's happening in the market is companies are trying to diversify their funding away from traditional sources. If you have $100 billion of debt, you don't want all of that debt to just be a QSIP bond. Maybe you want some sort of structured solution. Maybe you want something more private. When things get volatile, you want to have tons of options in terms of capitalizing your business. And these businesses are just, with a very small percentage of their overall balance sheet, diversifying their funding.
There's almost $2 trillion of investment grade debt coming due. Actually, $2 trillion of high yield debt coming due in the next 4 years. There's $1.5 trillion of investment grade debt coming due. How much do you think is going to get refinanced in the private world?
Again, very small percentages would make a dramatic impact on the private markets. We all have to start defining the private markets in a much broader way. We've all defined it as middle market lending, a $1 trillion marketplace. We define it, as many of my colleagues have talked about this morning, as really a $40 trillion marketplace, which really exists predominantly in investment grade and anything that's non-traded that sits on a bank or insurance company balance sheet. And when you use that definition and you talk about $2 trillion of refinancings or $3 trillion of refinancings, it's a very small component of the overall capital needs. And again, we're $500 billion. We tend to get a lot of attention when we provide a loan to Air France. But in the context of our overall balance sheet, it's actually relatively normal course.
Yeah, I want to fold in two ideas here. First of all, and we've seen this so many times in the cycle of global Wall Street, is there a brain drain going on right now in your world from the conventional banks over to the Apollo-type institutions? And because of that brain drain, do you have a negotiated leg up in looking and reviewing a transaction?
Well, most of our investors are retirees or pensions. They have a longer period of time. So when we're talking to a company and we're trying to provide capital to them, it's matched. So it's all about balancing both that commitment from our investors, retirees, and with the needs of the company. When you have that leg up relative to someone who has to provide capital on a very short-dated basis, we're just going to be able to create much more unique solutions that fit the company better.
Well, I mean, know with Air France KLM, you got decent discounted hotel rooms in Paris, which I don't have, folks. Let me tell you right now.
We got a guy for you.
But is that a duration transaction where you have a leg up because you're looking out, say, 10 years, or you tell me perpetuity, 50 years, versus a conventional bank that's worried about a 3-year or 7-year rollover.
Yeah, with that, it was taking a specific asset and structuring it in a way that would tie to a very specific pool of capital that was probably not logical for the CUSIP market. So it's just very specific, and in each company, each situation is a little different, and you have to have the flexibility of capital to provide that to make it work for the company.
Have you been surprised that we haven't seen a big sort of catastrophic credit event after decades of zero rates that suddenly spiked upward? And here we are. There is everybody warning of Armageddon. Nothing like that happened. Are you surprised? Is there going to be a bill to be paid at some point, or was this actually exactly the right approach?
Well, regulation worked in a lot of ways. Right? We deleveraged, the banks deleveraged. Typically, you have financial crises from either some sort of over-levered balance sheet or some sort of credit crisis where there's actual true losses. The system is actually been delevered, generally speaking, and the capital's finding its way. The assets are finding their ways onto the right capital, which is really less levered investor capital. Clearly, we're concerned about certain parts of the economy that probably over-earned during COVID. There are very big changes in migration patterns going on in the U.S. where you're going to have parts of the U.S. economy that are going to do much worse than other parts of the economy. Obviously, South Florida is doing fantastically well. I'm from Miami, so I'm going to give a little shout to Miami. But Miami, where you have millions of people moving down there, you look at commercial real estate rates, you look at building, you look at occupancies, you can't find a place to live. Or if you go to places in the Midwest or other places where you've seen migration, people leaving in really droves, you're going to see a totally different mini economies. And we look at economic data at the U.S. level, and we never break down the data in specific microclimates. I think you're going to see microclimates pop up as you have structural changes from the post-COVID world.
I'm looking right now at just how much yields have risen for a lot of companies. Most companies are not paying this, right? And we keep talking about this, the idea that maybe the headline number is 8.5% for high-yield public markets, but in reality, people are still paying 4 to 5%. When does it become punitive? What's the rate at which you start to wonder whether it's worth charging a company based on their viability going forward, their ability to keep existing and pay you back?
Yeah. We've raised 120. We went from 125 trillion of total debt to 250 trillion of total debt in the last 15 years. Clearly, higher interest rates are going to impact some companies that either took on too much leverage or their business is more cyclical. And when we go through a slowdown, they end up having too much debt. So they'll need either equity capital, they'll need to PIK interest, or they'll need some sort of structured solution to make their balance sheet work. I suspect defaults will go up. I suspect there'll be losses in certain sectors, just like any other cycle. I think the common lens is to look at the last cycle and say that's where all the problems are going to be, which is housing or banks. I actually think both those asset classes are in pretty good form from a credit perspective. There's other things that really assumed interest rates would be zero forever, and now they're going to have to live with those capital structures, and I suspect that's where you're going to see the core of the problem.
Okay, so I understand everything's perfect at Apollo, that's the act, but the answer is there's shadows out there. Which is the shadow you're most worried about?
Again, I think there were certain parts of infrastructure that assumed that rates would be zero forever, and then they built the capital structures. So LaGuardia is going under? LaGuardia is definitely not going under. But I would say there's certain parts of the capital structure where you just have too much debt, and when that debt has to roll.
Okay, give us some color on that. You know, nobody's watching.
Is it the car companies? Is it tech companies? Is it?
We need to bury somebody here today. It's a tradition.
Yeah,
You're the chosen one.
So I would say, generally speaking, anybody who assumed that interest rates would be zero and they have to roll their debt. But we're not going to go into.
He went to the Zeltner School of Charm. I got nothing out of this.
Yeah, it's like specific names that you're going to end up.
Put a hook on
John Zito, thank you so much.
Thanks,
really
guys.
appreciate it.
How about those dolphins?
Deputy CIO of Credit at Apollo. And
See you guys.
look.
Don't leave now. We're still on
we're still on air. He's like,
it's his first time. Yahira, do something.
No, but this is really the key question, right? How do you pinpoint who's going to have a hard time and who isn't? Because right now, it's not a default cycle like we got used to
You never
back
see
in
it coming.
2008.
I'm in the camp. You just never see it. You can think as hard as you can with the smart people here, and always get wrong what the surprise is down the road.
And this year, the surprise has been that we did not get the recession, and we didn't get the shadows that everybody thought were in the works.
We're here right now with the Standard & Poor's 500 down 0.3%.
I will just say, I'm actually really interested in Smuckers. I know this is crazy, but I'm really curious about all of these smaller companies and what they're actually saying. They aren't seeing a significant impact from Ozempic and weight loss drugs. We talked about that earlier. But the fact that they see net sales coming down, the fact that they see full-year adjusted EPS coming down, the fact that they've got free cash flow coming down.
You're missing it. Come on. Come on, you're upset. I mean, Mark Rowan called me up and he said, look, because we're doing this the same day as Smuckers earnings, we're having Twinkies here at Apollo Global Management. The news was Smuckers, Orville, Ohio. It's as stodgy as they come. And the answer is they did a bolt-on transaction. It could have been financed by Apollo Global Management, and they bought Hostess. So you got a bolt-on now of, think of this, you got Twinkies. Zeno's entourage is over here, they're killing me. You got Twinkies and orange marmalade. Think of the possibilities.
Tang, orange marmalade and Twinkies is literally the worst thing. What are you trying to do in the morning for people at breakfast? They've got this beautiful breakfast over here talking about Twinkies and orange marmalade. Well, J.M. Smucker is up 3.2%, but to me, these are some of the interesting earnings to watch.
You're correct. What's serious here, Lisa, is these stocks have been not participating.
Exactly.
Liz Ansanas at Schwab's done some great stuff on this, and you just wonder, seriously, what they're going to be. We're going to talk equity here at Apollo. They do equity here at Apollo, and we'll see how that goes with Matt Nord and Mike Downing, but coming up as well, Anne-Marie Horder in Washington, John Farrow, Lisa Abramowitz, and Tom Keene from the offices of Apollo Global Management. Good morning.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Is this going to change how you approach US politics? Who you would endorse for 2024?
No, it's not going to change.
Do you have a favorite candidate?
No. It's hard to believe with 350 million people in this country that we're down to two.
Are you disappointed with these two?
Personally, I'm disappointed.
Mark Rowan, Apollo CEO, with a non-answer there to John Farrow on the presidential election coming up. But a really important conversation, not only, Lisa, on the work here, his vision here for his Apollo Global Management, but also a very delicate conversation on the anti-Semitism that we're seeing at his University of Pennsylvania.
Although what he did say about the political backdrop heading into next year was really interesting. This disappointment that he feels about the two candidates who are going to be in the running, saying, can't we do better? And he's not alone with that. I think it's really interesting to hear increasing calls for Chris Christie and even Ron DeSantis to drop out to coalesce around Nikki Haley, as people are saying, who can possibly run against the former President Trump? And likewise, on the Democratic side, this is really an interesting moment where everyone assumes this will be the race, and yet people are trying to chip away at it around the edges.
And I get out the idea of the calendar coming into this wonderful building. There's an iconic Christmas decoration that they have here. If it falls over, it's going to kill you. It's a candy cane kind of thing here at this acclaimed building, the old Bank of America building. And the answer is, Lisa, the calendars move in, and the calendar for Chris Christie and others like Mr. DeSantis is moving in real time to January 22nd or 23rd.
Yeah, I mean, this is going to be, honestly, an evolution. And the big existential question hanging over it is, are we going to still end up with a Trump versus Biden kind of race? Quieter markets today as we wait for the economic data. JOLTS comes out at some point. McKee all over that. 10-year yield in 3 basis points, 4.22%. Future's a little soggy, but I'm sorry, it's economics, finance, investment. Guess what? Right now, it's all about the economics of Friday. And can we continue with the Goldilocks discussion, given how far we've gone? All I can say is, it's kind of the hangover after last month. Last month was really amazing as far as annual returns for a month. And basically, this is the hangover. As I can't take the bait on that. Joining us now with a hangover
I was
is a
hoping
Christmas
maybe you
party
would.
star in Washington, D.C., Bloomberg Christmas party correspondent, Anne-Marie Horton. Anne-Marie, I look at what's going on here. Thank you. That's one of us. I look at Anne-Marie Horton at where we are now, and it's completely clouded by a war that has become on the edge of chaos. And as I mentioned earlier, Anne-Marie, on a 12-hour basis, we really don't know what's going on. Describe in Washington the frantic nature of the study of the war in the Eastern Mediterranean.
Well, to your point, Tom, it's changing rapidly. We thought that potentially that pause that we had, that 10-day pause, that truce at the moment to exchange hostages and prisoners and get humanitarian aid, it could potentially be elongated, and there would be more hostages that would come out. We heard from Jake Sullivan, the president's national security advisor, yesterday, talking about the fact that this cratered because of Hamas, and the State Department saying that Hamas didn't want to give up the remaining women that they had control over. So now what you see is Israel really going into the south, and the debate that's taking place here in Washington, D.C., and there will be an intelligence briefing on Capitol Hill today in the Senate, not just to discuss Israel, but also zooming in will be Volodymyr Zelensky, the Ukrainian president. So Ukraine will be top of the agenda as well. But the debate surrounding all of this aid is really two things. Within the Democratic Party, is there going to be strings attached to aid to Israel? We've talked about it time and time again, this pushback from some of the progressives about how Israel conducts this war in Gaza. And then, of course, when it comes to Ukraine, for Republicans to sign up to that and not filibuster this or not vote this down, they want to see stricter laws and stricter asylum laws, parole laws, and more funding towards the U.S. southern border.
When the administration speaks to Israel under war, who do they speak to? Is it just about Mr. Netanyahu, or is it more complex than that?
I think it's more complex than that. Look, we've had Bill Burns in Qatar for days or weeks. He's been, of course, the U.S. top diplomat, but really invoking himself into this crisis because his counterpart is the head of Mossad, and we've also seen that individual go in and out of Qatar. So there are different individuals depending on what is happening on the ground, what the U.S. wants to see done, that they will reach out to and talk to. It's really been counterpart to counterpart. I also think, when we had Secretary of State Antony Blinken there for his third trip to the region since October 7th, he spoke to the entire Israeli war cabinet. So it's not just Prime Minister Netanyahu, who of course the president continues to remain in touch with, and there's been a number of phone calls throughout the weeks. But it's a larger apparatus with all of these individuals, whether it's the head of the IDF, head of Mossad, or head of the government.
And Marie, we talked about Ukraine aid and how the president has really pushed forward this idea that we're running out of time and that money will run out for that effort by the end of the year. How closely tied is it being sort of paired with the idea of border security, securing the border for the United States, and how much Democratic support is there at a time where states like New York and Connecticut have increasingly felt that pressure?
So two things. I think these things are definitely linked. The president, when he talked about this package and asked Congress for this package, had all of these priorities linked: the U.S. southern border, Ukraine, Israel, and strategic partners in the Indo-Pacific. For Republicans, though, to really be able to sign up for it, though, because we have seen divisions within the Republican Party on Ukraine, and even those hawks, defense hawks, that want to see money to Kyiv, recognize that they're going to have to make sure that they're going back to their constituents and also bring in other members of their Republican Party with not just funding on the southern border, but a lot of this is coming down to policy, and that's why the talks broke down over the weekend. But Chris Murphy, a senator from Connecticut, who is really a part of these negotiations and integral to them, said, you know, there's some things on here that no Democrat would vote for. So they need to get that language correct. But to your point, Lisa, there is pressure on Democrats to make sure that they are delivering something tough and substantial when it comes to the southern border, because we've seen the letters from the likes of Governor Pritzker. We've seen the outrage from Mayor Eric Adams of New York and Governor Kathy Hochul, who say that they need more support if they're taking in more of these migrants.
How much do you see the Senate sort of taking the lead from the House when it comes to these sort of border debates, given the fact that there have been questions about leadership and how strong it is in the House, and that the Senate has been so quiet amid all of that turmoil?
Well, all of these conversations at the moment are happening on both sides of the Capitol, in both chambers, but you're right. The Senate is taking the lead on this. This is where the deal will be done. You also see the Senate have strong support in their Republican leaders for the likes of aid to Ukraine, which Shalonda Young yesterday sent a letter to Congress saying time is running out. There is no extra pot at the end of the year that we can draw down from, and we will kneecap our partner in Ukraine at the hands of Putin if we do not send them funds. The likes of Senator Mitch McConnell went on a tour, really talking to the press about how actually this builds up the U.S. industrial base, and this means jobs, say, in Alabama, trying to explain what this money actually means. So that deal is going to be cut in the Senate, and this is why you see a lot of these Republican senators talking about tougher asylum provisions, because they want to make sure that the Republican colleagues in the House can pass it and get it through. When it comes to the House, for them, really, I think one of the top priorities is making sure that they do not shut the government down. That's going to be the next debate come January for the first part of that tranche of this two-laddered approach to the continuing resolution. But yeah, it's been messy, to say the least, in the House. I mean, last week they ousted a member of their own party, and they have an even slimmer majority now.
Right. Anne-Marie, thank you so much. Anne-Marie Horton, our Bloomberg Washington correspondent here, with a battle in the Eastern Mediterranean coloring all of the discussion in Washington.
Yeah, well, right now, there's also the geopolitics that really have overshadowed a lot of the domestic haggling. And I think about what's going on with the two wars that we were just touching on, but also the oil backdrop. I think that that's kind of interesting right now.
Well, the oil backdrop's there, and a headline out in the recent minutes here that Mr. Putin will meet with the leadership of Saudi Arabia of some form. I don't have that in front of me, but that just shows you the world goes on, the travel goes on away from war.
Well, this is going to be Vladimir Putin's first foray outside of his country. He's said to be meeting with Saudi Crown Prince during his visit, according to the Kremlin.
Did you notice that people here at Apollo Global Management get in at the crack of 8:30? Did you notice that?
That's called life, Tom, outside of our bubble.
I'm going private equity. Good morning from Apollo Global Management, Bloomberg Surveillance.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance, good morning, everyone. Jonathan Farrow at the Breakfast Bar here at Apollo Global Management. We are here, Lisa Bramlett and I, working away as John chows down. A wonderful visit here. We finished very strong here. Matt Nord and Mike Downing to be with us here. Zelda said Athena is like the biggest thing here.
Yeah,
I mean, we're finishing strong here with that. But, you know, right now we're looking at some economic data and, you know, forget about all this fancy finance talk. Friday matters.
Well, yeah, Friday matters, but so too 10 a.m. when we get JOLTS, which I know you're so excited about, as well as ISM services. Actually, ISM services, we haven't talked about enough. We continue to see the decline, the recession in manufacturing offset by services. Can that continue?
I agree it's a mystery. I agree it's a huge mystery. There's a great Wall Street Journal chart showing outright goods deflation. A lot of people have predicted that, and that's part of the disinflationary story. But like the mystery of services in the United States has got to be front and center into the Q4 guesstimates.
So then we get initial jobless claims, which is going to be big. ADP on Wednesday, which no one cares about until they do. I keep saying that because it's true. Everyone's like, no one even understands the correlation. And then, you know, it comes out in a surprise number and people get
We're going to do the data check. The markets are open. Okay, that's the data check. This morning, it's sort of quiet out there. Yields are in a little bit as well. Let's go to Michael McKee, who will save the moment economically as well. Michael McKee, Torsten Slok of Apollo Global Management makes very clear this is a dual jobs report. The importance of the claims report Thursday rolling into the jobs report Friday. Are they linked in any way?
Well, they're not specifically linked because one measures job losses and one measures job gains, but they are in the sense that if we're seeing more job losses, then theoretically job gains go down. Also, the fact that continuing claims have been the focus in recent weeks as they've been higher. That suggests people are having a harder time getting jobs, which should lead into the JOLTS report showing fewer job openings. But that's kind of neither here nor there because the JOLTS numbers expected at this point to show, and that comes out at 10 o'clock today, that we're still well over 9 million job openings. So the labor market, is it tight or not? We'll have a pretty good idea by the end of the week whether it's changed in the last month.
We've talked a lot about the labor market, Mike. We haven't really talked about services, and I think it's important, especially given the record spending online, given the fact that we see record amounts of travel over the Thanksgiving break. How much are you expecting to see that strength continue versus signs of weakening?
It looks like at this point there's a little bit of a mixed picture coming. The forecast is for the ISM Services Index to go up a little bit, to show a little more strength, which would be interesting given what you were saying earlier about manufacturing staying in a recessionary territory. But new orders are supposed to come down. They still all remain high. Still in the 50s, still showing expansion. So it's hard to tell exactly what it's going to tell us. But it is also going to be interesting to see what happens with prices paid, because they're expected to fall. If service industries are expanding and the prices they charge are not going up by as much, then that's good news for the Fed.
Right. Michael McKee, thank you so much. Look forward to it. Seriously, the JOLTS report coming out here, and then on we go to the labor economy of America, where we'll be at 8:32 on Friday, is a mystery. Farrell came to talk to Rowan. You came to talk to Zeltner. I don't give a damn about any of them. I just want to talk to Matt Nord, who's co-head of equity here at Apollo, who has the coolest board membership as well. And Lisa, I'm going to go back 54 years, sitting in David Eddy's basement, and there was an album out that Jimmy Page produced. It cost $31,000 or something at the time, and it was your Led Zeppelin. You're a board member of the Rock and Roll Hall of Fame, most important institution in America. And there was Zeppelin inventing it in 1969.
Yeah, well, it's great to
you didn't expect this, did you?
No. Well, I'm happy to talk about it. We like to have fun at Apollo, and I'll take physical graffiti if that's okay.
Okay.
Yeah.
It's for, we look at that, and that's a time here, and the time of private equity is a lot less. It's not 54 years. It's happening in real time and rapidly. Where's private equity going to be at Apollo and as an industry in 5 years?
So I'm tremendously excited about the outlook for our private equity business. All of Apollo is growing and performing well. PE continues to be a really important part of our business. So if you look at what we've been able to achieve recently, we closed Fund 10 over the summer, $20 billion in commitments. And if you look at Fund 9, it's appreciated 16% year to date. That's on top of 23% last year.
How'd you do that without opening Apple? How'd you make 16% without owning S&P 500 or Apple or Microsoft or NVIDIA?
So what we try to do is find the best risk reward across any market environment. We're not timing a particular market. And so we'll pivot depending upon where we see the best opportunities. And our job ultimately is to buy good companies, capitalize them well, and put these management teams in a position to be successful. And then once we close on these deals, we're generating increased earnings growth, free cash flow generation. And so this is meant to work across all market environments.
Are you losing customers to private credit?
Well, I think the question, if you're competing for allocations of capital, is what differentiates you? So coming out of the environment that we've been in a bull market, everyone worked, right? Everyone made money. In this environment, do you have the tools to generate returns with this sort of uncertainty? And because we've been together for such a long time, we've done this for 30 years, and we have that ability to pivot, we've continued to demonstrate and receive really good support from our investors.
What kind of returns are people looking for to justify the risk that is bigger in equity?
So I think that's a really important question, because we always think about where is their excise or outsized return per unit of risk, right? Where are you getting compensated? And if you're willing to take levered equity risk today with the outlook for rates, the outlook for the economy, I think you need to generate mid-20s rates of return and do it with really conservative assumptions.
So what's the leverage ratio there? I mean, it's not 1998. Don't tell me you're doing 20-1. But what kind of, could it be triple leveraged? I think
Stop getting so excited.
What kind of leverage do you have to make those returns work?
Well, I think it starts with purchase price. So typically we're buying assets at around 6 or 7 times EBITDA. That's the purchase multiple. And when you're buying well, you're using less leverage.
Okay.
We're only leveraging companies around 3 or 4 times.
Pro tip, are you going to buy Hollywood? What a mess out there right now. What are you going to do about the mess in Hollywood? You talk about EBITDA. I don't think Iger can count the EBITDA right now. What's the opportunity in American entertainment after the train wreck of the last 24 months?
When we think about portfolio construction, we're not targeting a particular industry. We really just want to be bottoms up and find the best risk reward. So if we can buy good companies, good cash flow, we don't need to make bets around disintermediation or otherwise.
A recent transaction.
Right.
Give us a recent transaction.
So we've been incredibly active this year. And if you look at Fund 10, which is our most recent fund, we did the take private of Arconic, which is an aluminum fabrication business, Univar, and chemicals distribution business. These are sectors that we have followed for years. So our partners cover sectors, and particularly a lot of take private transactions.
Right.
I think CEOs are they've woken up to the fact that private equity is the long-term money. I think there was this perception that private equity is the short-term money, but your ability to invest for the long term is really enhanced with private equity.
Okay, go ahead, Lisa, please.
I was just going to say, how much is the idea of not having to sell fortifying this idea that maybe there aren't losses even when there are losses? In other words, how much is sort of a fiction of not having to price in real time, even at a time where there's a lot of price destruction?
I think that's a little bit more of an issue for the industry, less for us. I think a lot of sponsors overpaid for assets the last couple of years. And the air is very slowly coming out of that balloon. And so I think you can question some of the private market valuation multiples. Again, for us, buying at 6 times, we tend to see multiple expansion when we sell it. So I don't have that concern for our business.
Are you investing in non-profitable tech?
No, that's not for us. Okay. We like cash flow. We like cash-on-cash returns. We're very happy with our model.
So give it, just for our audience, which is fascinated by this, you're coming in at 6 times EBITDA, down the income statement, some form of balance sheet construction. How long is your expected duration on a blended basis to where you take that out? At what level of EBITDA? Are you going from 6 to 9? Or are you trying to pop this thing with leverage out to 12 times EBITDA when you exit?
No, so we're underwriting to conservative assumptions. What we want to do is return capital along the way. So the average hold may be 4 or 5 years, but I think this is one of the biggest issues for the industry is how much capital has been returned. And for these sponsors that have overpaid for assets and over-leveraged, it's very hard to generate returns. For us, if you look at Fund 9, we've already returned about $10 billion of capital. We've already returned about half of our invested cost basis, which is best in class for that vintage. So it's another benefit of buying well. We've taken companies public, we've sold assets, we have a lot more flexibility.
Well, in the shadow of Charlie Munger, with all that we've studied of him in the last week and the death of the giant, I mean, what it comes down to is you're getting a preferred cash flow along the way.
Correct.
Give us a number on that. Are you picking up, you know, not over LIBOR, but over a conventional buyback dividend? Are you picking up another 300 basis points off that?
It's a great question. So when we target our returns, let's say 25% base case returns, we're typically underwriting to about 10 to 15% cash-on-cash yield in the first year. And then earnings growth, and then we have a team of operating partners that can help, you know, really drive further value creation from there, but it starts with that cash flow yield.
I'm going to tear up here. I can't tell you the last time somebody said, yeah, we could do 25% a year.
How much are you seeing fee compression?
Sure. We haven't seen it in our flagship private equity business, but I do think that when you have a platform such as ours and you have more sophisticated investors, it makes for a more dynamic relationship where we can really have platform-to-platform relationships, and there's synergies across the entire platform.
How much are you counting on the capital markets opening up to be able to exit in order to continue returning capital in the same kind of way?
So, you know, again, with less leverage, we have lots of flexibility. I think the IPO markets will be a little bit stronger in 24. It'd be hard to be worse than 23, but we're not counting on that. And so having all these different levers, we're engaging in a number of conversations right now around selling assets. I think we have different pathways.
I'd love to know what you think after this wonderful discussion about duration and patience, about CTAs running around with their heads cut off, trying to make swings in the market. I mean, we've got a hedge fund industry right now basically day trading, from what I can tell. What do you think? I mean, by definition, it's alpha destruction.
Sure. You know, for us, it's really about long-term value creation. We're not market timers. You know, this team has worked together for a long time. We've been doing this for 30 plus years. My partner, David Samber, and I have been here for 20 years. And this is a model that is focused on discipline, downside protection, strong returns across all our market environments. That's where
we're out of time, but thank you so much for putting Bernie Taupin in the Rock and Roll Hall of Fame with Tumbleweed Connection, greatest album of all time.
I appreciate the time. Thanks so much.
Matt Nord of the Rock and Roll Hall of Fame with us here.
And Apollo.
And Apollo Global Management as well.
If you are just joining us, let's just take a quick look at the scores, which aren't that great today. We just really haven't seen much in terms of market action. A little bit of softness, though. S&P lower by 0.3%, 45.63.
It's going to be interesting to see here. You know, we gave Mike McKee short shrift here because we want to talk to Matt Nord, but the bottom line is it is an economic week. We can't forget that. And let us, you know, talking to Torsten Slok, it's fascinating to me, is this the jobs report where we have a negative whisper number, or a tilt below whatever the number is, 180,000.
It doesn't sound like it. And part of that, I mean,
it cuts both ways to me.
To me, it's that we keep talking about the micro industries, right? The idea that different sectors have different pressures, got over leveraged at different times, and they're kind of working like different cylinders of a car, kind of calibrating perfectly. Do you like that? That's
I like that. It's very good. It's, you know,
about as far as it goes.
Kevin Tynan car talk. I look at it, Lisa, as simple as I was so wrong 90 days ago on subdued Q3 GDP. Maybe it was 100 days ago. And are we going to do that again? Are we going to do this ballet again?
If you look at the Atlanta GDP now, it's pointing to 1.2% for the fourth quarter, which would be the lowest growth going back to the second quarter of last year. That said, it's not that bad, especially considering that we're coming off, what, 5% in the third quarter? That's the kind of level, yeah, deceleration, but from what? And that's the reality check.
What did you learn about credit here today?
From credit? Well, I think it's going to be a sort of balance between terming out the existing debt structure. I think it's interesting. Actually, I thought that was really interesting. The idea of what kind of bogey is necessary at this moment, how you achieve that in this world.
We're going to continue here at Apollo Global Management. This has been a wonderful visit. We're going to finish strong here with Mike Downing of Athene. We're from New York.
We're in New York.
From below 59th Street. This is Bloomberg Surveillance.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think the world is debanking. Everywhere in the world, regulators are favoring investors over banks. That does not mean we're going to see a sun shift. That does not mean the banking business is going out of business. On the margin, though, the growth is going to take place in the investor marketplace rather than in the banking system for good and valid reasons.
Mark Rowan, Apollo Chief Executive Officer, speaking about some of the opportunities going forward for the private investment sphere that's taking on an increasing amount of the activities formerly relegated to banks. We are here at Apollo headquarters in New York. Tom Keene, Lisa Abramowitz, John Farrow is down getting breakfast, or I think he's not getting breakfast anymore. I think that he's
had
now
a big breakfast.
Probably in the studio.
They gave him a biscuit, sausage, and eggs, and he said, Mark, I can't do this. I need something bigger. He said, big breakfast.
Well, we'll catch up with him in a little bit. A bit of softness in markets, but no drama after last week's big week. And given the fact that we had a pretty massive year that was November of returns, we could just see a bit of a decline in the S&P yields continuing to go down. This is interesting given the retracement. 10-year yields now at nearly 420, Tom. income. That sort of snuck up on me,
Well,
given what people have been talking about.
I missed this. On the desk here, I'm so busy working with the big breakfast that I'm looking at a 420.69, and I'm sorry, it's 4 or 5 basis points in. A 419, breaks an important point, and you begin to wonder, what's the path to 399 given the economic data?
We were just talking about debanking. I want to talk about de-risking more importantly. Nobody wants to be the pension business. No one wants to actually come up with the liabilities and match them perfectly, especially after a number of years of zero rates and what that meant. One person has been focused on this and was the sleeper star of the recent earnings season, Mike Downing, Chief Operating Officer of Athene, the insurance arm here at Apollo. Thank you so much for being with us, Mike. I want to just start with that, the idea of why are you so popular?
So first, happy to be here. Thanks for having me. But I would say the reason we're popular is that the pension defined benefit landscape has really been in decline for years. The first part of I've been in retirement for 30 years. The first 15.
Lucky you.
That's what I was thinking too. Carry on.
The first 15 of those years was watching the defined benefit landscape slowly implode through regulation and others. And so what you have now on a lot of these companies' balance sheets are legacy obligations. It's no longer a core part of their strategy. They've switched to defined contribution plans, but the risks are still there. And so it's a great place for an insurance company to step in, take over the risk, de-risk the assets, more conservative assets, backing it with capital, and it's a really natural fit.
What's the kind of bogey that you're looking for? We were talking about this earlier, how there was the old 8.5% bogey that increasingly people said was impossible as rates went lower and lower, and a lot of these investment firms, a lot of these companies locked in investments at those rates. Now we're looking at real, actual income. What is the bogey that you're targeting for some of these things?
In terms of asset yield?
Yeah.
Yeah, so with our assets in the insurance world, the key difference between companies and insurance entities is we're regulated pretty heavily in terms of the types of assets we invest in. So our assets are going to be dominated by corporate bonds, high quality structured assets, and we're really just looking for incremental yield outperformance to really provide a good value proposition for these sponsors so they can lift and shift their pensions without really having to kick in an extra cash.
For those of you scared stiff about your retirement, not that I would know anything about that, this is the most important conversation of the day. It all stayed in Illinois, where you were. At Athene, West Des Moines, Iowa, actuarial analysis is gospel. It is religion.
Absolutely.
You just went through, and this goes back to Sun America and people that were competing with Sun America, 14% annuities and the idiocy of 30 years ago. Then we had zero interest rates. You guys about rolled up and died. Now, boom, you're back to a normal rate environment. Can our listeners and viewers recover their retirement plans now that we're back to a normal rate environment?
Absolutely. I think we're at the start of a reawakening of annuities, and we really are at the start of the golden age.
What kind of annuity is going to matter here? Are we talking about variable annuities, or are we going to go back almost on the edge of John Farrow and the Brits? I remember a headline in the FT, the annuity, fixed annuity was 3.98%. That doesn't get it done, does it?
It doesn't. And so what we're talking about at Athene is simple retirement guaranteed income. Not a lot of fancy bells and whistles. We saw the VA crisis with promises that actuaries made, couldn't keep. It really put a lot of companies in trouble, lots of complex legacy liabilities out there. Athene's business model is simple. It's guaranteed income. We're looking for some outperformance, and in these markets of late, annuities are a very viable alternative to equities.
I would suggest we have to fix this now. Under the great historic work of Roger Ferguson, the former vice chairman of the Fed, his work at TIAA-CREF, do we need further emergency legislation in Washington to allow people to put more in, because they're just not going to catch up after the last 15, 20 years?
Yeah, I think we're seeing more of that occur with Secure Act 2.0. We're seeing steps in the right direction.
Just steps in the right direction, no question about it.
A lot of it's mindset. So the tools are there. The annuity market's huge. It's $300 billion a year. It's still vastly underutilized. That's in large part not due to lack of regulation. That's in large part due to the fact that they've been part of this secret insurance land, and more investment advisors really need to look to their customers to say, hey, a staple of your portfolio should be an annuity.
I mean, people don't know this. Lisa's modeling retirement in 5 years.
Well, that's exactly where I was going to go. Yeah. Retirement, not in 5 years. But really, what is the appropriate age at this point for people to actually retire, given how much money they need to build up?
I'm thinking 90.
No, seriously.
Yeah, so our sweet spot is 55 to 70-year-olds.
Oh, you're killing me.
And
still? Really?
Still. And so it's a transition. So if you think about where the world is today with retirement, defined benefit plans are gone. So people that are saving, what do they have? They have big piles of assets that have been accumulated. And that's getting you to retirement. But how do you get through retirement? And so the way you get through retirement is through an annuity. An annuity can stabilize your principal. An annuity can guarantee return. An annuity can create payouts so that you don't outlive your assets.
No, the way you outlive it is your kid gets a job at Apollo Global Management. Well, that's the way it works out.
But this is the issue, right? How do you know? How do you plan at a time where the life expectancy should be expanding? It wasn't because of COVID, but that was a blip, hopefully. But people are living so much longer. We talked jokingly about Ozempic. What happens if that makes us all live forever because everyone is thin and fit? But going forward, is there this sort of point at which it doesn't become feasible mathematically?
I think it'll always be feasible, right? So unless lifespan is kind of walled off at age 120. So
really,
hopefully that'll change in the
maybe I
right?
don't know. Go on.
And so what'll happen is it's so people are living longer, but incrementally longer, and that's where the protection really fits in well. Is it protects against the individual that might live to 120, and we look at it on average. So from the actuarial standpoint, we look at some people die at 60, some people die at 120.
Let me ask you this, and I know it's anathema to you, but I'm going to go there. I've got a real not-in acquaintance with the triple leveraged all cash fund, which is taking cash, you take out some fees, everybody makes money. Is the solution here to take the conservative structure of Athene annuities and provide leverage into them to get a better return for conservative types?
Absolutely, and not even conservative types, right? So if you think again about what an annuity delivers, it's not going to deliver a home run. But at age 70, you don't want a home run. What you want is confidence you're not going to outlive your retirement.
Can you lower the tuition payments, please?
And that's what annuities do. They help retirees retire in confidence that they're not going to outlive.
You know what I find interesting? We have this pool of capital, and it's not actually being spent. And it's sort of the assets that increasingly there's a pool of cash just sitting in assets that don't ever come out for a long period of time. How does that shifted in terms of all of the savings that just are not going to get spent because they're basically pools of capital to earn income off of?
Yeah, that's a great question and great observation, Lisa. And one thing we've seen, so as rates have gone from basically 0 to 3 or 4%, a lot of that cash that's been sitting on the sideline has actually flooded into the insurance market. And we've seen volumes, the volumes in the deferred annuity market have almost doubled overnight from low rates to, because we're finally getting yield again. And money that was sitting in money markets earning 1 or 2 basis points, CDs earning 50 basis points.
Right.
A lot of that's now migrated to the annuity market because the annuity returns have kind of moved real term with rates.
We're going to go on to other things. If you see Zelda or Rowan in the hall today, can you say thank you?
Absolutely.
For this has been a wonderful 3 hours.
Absolutely.
We've not only we learned a lot, but you know the coffee's decent. Can we come back?
Absolutely.
Okay.
Come back anytime.
You know what we can do? West Des Moines, Iowa. February, it's a treat.
You're just reaching me. All right, I spent time in the Dakotas in the winter. That was a treat. Right now, in markets, you are seeing a bit of a softness. We were talking about that 10-year yield, and I do want to pick up on that. Yesterday, unclear what exactly was driving a bit of a turnaround. But yeah, under 420 and grinding lower as the session grows on. This is some of the lows that we haven't seen since the end of August.
Their annuities are going to gross 2% here any day.
Well, this is the question, right? Going forward, coming up on Bloomberg TV, Mark Smucker to talk about Twinkies and peanut butter from Marmalade Jam. No, J.M. Smucker, President and CEO.
Twinkies.
Well, okay, we'll hear about Twinkies.
Thank you, Apollo.
Thank you, Apollo. It was really wonderful to be here.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Coming up, the team at Apollo say the Fed put is back as Alarian thinks Powell risks losing control, and the recent equity market rally meets gravity. We begin with the big issue. Too far, too fast.
Things are going a little bit too far. A little too fast.
This market is priced for perfection. It is beyond perfection at this point.
The markets have really pushed the envelope here to such an extreme. We've had the great rally. Big rally last month.
We are very much ahead of ourselves here.
Too far ahead of the Fed.
The market is misinterpreting some kind of enormous Fed pivot.
Markets have now priced in over 4 rate cuts next year.
To have so much in the way of rate cuts at this point, with a soft landing, it is really quite curious.
The market is discounting, a Fed that can land this thing perfectly without any hiccups.
Every hard landing starts looking like a soft landing first.
The headwinds for the economy next year are woefully underpriced into market sentiment right now.
Because everything rally remains challenged.
It's by the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
Stocks meet gravity. Let's have that conversation right now. Morgan Stanley's Andrew Slim and Cameron Dawson at New Edge Wealth. Cameron, first to you. Have we moved too far, too fast?
Well, clearly equity markets are overbought here. We have seen that movement up in November, which resulted in things like the RSI having an overbought reading. That suggests that you could have some digestion. You also have the inverse of that, of a lot of yields being oversold and finding a little bit of footing. The question is, once you have the digestion, where do you go from there? And the thing that we're asking mostly on the yield side is, what kind of data would really justify this 120 basis points of cuts being already priced in? And how much more weakening in the data would you need to see yields move even lower from here? Which just raises the point that maybe yields are upwardly biased if that data doesn't come in and justify what the bond market already has priced in.
Andrew, on the equity side, you were long stocks, you stuck with it, it's delivered big time. You said stick with mega cap tech, it delivered big time. Year to date, up a ton. What's the trade now for you, Andrew?
Well, look, my call this year, as you know, Jonathan, has been to be overweight growth and value and be underweight the defensive stocks. In the last couple of weeks, they've done very well at the expense of the mega cap 7. So I can't believe I'm saying it, but I think there is another opportunity to buy these very, very large companies that largely have produced stellar results, and they have huge stock buybacks coming next year.
Cameron, outside of that, we've seen these subtle leadership shifts more recently. Is that a taste of things to come, or are you on the same page as Andrew?
Yeah, rotation seems to be the name of the game, and we are asking the question of all this rotation that you've seen just in the past couple of weeks. Maybe that is the harbinger of what we have in 2024, which just means that those areas that have been left behind, that are trading, even some parts of the market trading near their 2020 COVID lows, if that's a setup for a big rotation and a relief rally in those areas. But I think the point is really good that there's still a lot of fundamental strength in the leadership names that have led the market this year, which just means that they've earned their leadership. We've seen huge earnings growth, 180% earnings growth if you look at the Magnificent Seven on average. The challenge next year, though, is that decelerates to 26%. That's still a lot better than the market, but that second derivative deceleration will be really interesting if we think about if they can maintain that same degree of leadership.
Stock's down a little bit this morning. We're down 1/3% on the S&P. On the NASDAQ, we're down by 0.4%. Mike McKee, tons of economic data through this week, climaxing with payrolls this Friday.
Absolutely. You were over at Apollo this morning. They gave you breakfast, right? And it was probably very good. Did you take more than you thought you wanted because it looked so good? That seems to be what's happening in the markets these days, is people are getting a little carried away with the narrative that the Fed is going to have to raise rates or lower rates depending on which way you're looking at it. They want to keep things steady, and the data this week are expected to make that case. We get S&P PMIs coming up in this hour. We'll have those for you. ISM services, JOLTS, ADP employment, jobless and continuing claims, November jobs, and that Michigan sentiment number where we watch what they say about inflation. And all of them expected to continue the narrative that the Fed has been following, that the economy is gradually weakening and a soft landing is possible. So if you're going to get a market reaction, it would be in the surprise. The services index are expected to show little change and prices falling, jobs measures, the labor market is loosening, and wage growth slowing. That's what we're likely to see on Friday. And then the sentiment index, little change with the inflation concerns easing. If we don't get any of those, then you could have a reaction in the markets. And then the narrative becomes this, that financial conditions are easing so much because we've seen rates go down in the markets and the pricing in of Fed cuts. Well, here are three different financial conditions indexes telling almost three different stories. The white line is the Federal Reserves, the blue line, the Chicago Fed, and the gold line is Goldman Sachs. Now, each one of these is different time frames as well, monthly, weekly, and quarterly. And the weekly and daily numbers show that there's not as much easing as anticipated. So what's really happening out there? The Fed is likely to look past what's happening in the markets now, figuring they'll change their minds sometime soon, and they'll stay the course.
Mike McKee, thank you. Just for the record, I skipped breakfast, but I did hear from TK. He's never leaving. He's moving in to Apollo Global Management here in New York City. Mike McKee, thank you. Andrew Sliman, I want to come to you on what Apollo said earlier this morning. Jim Zauter, Torsten Slog, saying the Fed put is back. Andrew Sliman, is the Fed put back?
I think for now, the data coming out, particularly next week, the inflation numbers will support that the Fed can back off. My biggest concern is next spring when the CPI numbers year over year are going to get tougher for inflation to show continued improvement. And then the question is, what will the Fed do at that juncture when it's going into election? That I don't know. But for now, I'm not worried about or need a Fed put. I think the inflation numbers are going to support. And that's why I think we could get another rally next week in the market surrounding the inflation numbers into year end. We'll have to see next year. That's the question of a Fed put. It comes later next year.
Cameron Dawson, what's your take on that?
I think the Fed put is always there. It's just a question of what is the strike price, meaning under what conditions is the Fed ready, willing, and able to step in and support markets. And because inflation has remained elevated, though it is decelerating and is above its target, we thought that that strike price is effectively lower. A good reminder of that is that earlier this year, we had some of the biggest bank failures in history, and yet the Fed continued to tighten policy afterwards. In prior times and prior cycles, the Fed would have been probably far more eager to ease policy. So yes, inflation coming down does increase their degrees of freedom. It makes it so that they're more able to tweak policy lower, but to truly deliver 120 basis points of easing without economic weakness and just inflation remaining somewhat above trend would suggest that that might be too aggressive.
Cameron, I'm with you. Andrew, not all rate cuts are created equally. If this Fed starts cutting because inflation is coming down but growth is still okay, I get it. Constructive view on the equity market kind of stacks up. But Andrew, what if growth starts to disappoint? This is something I know you're focused on. If we start to get bad data and the bond market carries on rallying, would you expect a split to develop between stocks and bonds?
Yeah, to me, that's the biggest worry, Jonathan, is if discussions of Fed cut because the economy is slowing, then we're not going to make $245, $247 of earnings next year, which is consensus right now. And that challenges the thesis. So in my opinion, it's really about the bond market. Watch financial conditions, watch credit spreads. If they remain tight, it's a sign the Fed can cut because inflation is coming down. If they widen out, there's a sign of more stress. And then actually, I think the market will rotate into the more defensive stocks that have really been the underperformers this year. That's what I'm watching. I don't expect that. So I think it's a combination of value and growth stocks next year yet again. But that is the biggest risk for next year.
Let's just build on that a little bit more, Andrew. How big is the disconnect right now between what the equity market is expecting in earnings and what the bond market is expecting from the Federal Reserve in cuts?
Well, yeah, look, I think that if you look back to all the bears on Wall Street at the beginning of the year, what they got wrong was earnings. Earnings are going to come in 220 this year. Most of the bears were predicting 170 and 180. So I don't put a lot of credence in Wall Street's ability to predict earnings. It's not historically been particularly good. I listen to companies, and I hear right now, I don't see a big earnings downgrade for what they see. But that's, they're looking at the next couple of quarters. And so if there was a slowdown in the business, I think it would come from the companies that we're talking to. But right now, I don't hear it. So I'm going to start the year with consensus right around 245, 247.
Cameron, just to build on that as well, do you think right now, looking at consensus expectations for profits, are they too great, or expectations for rate cuts, are they too large?
Yeah, I mean, if you look at underneath the surface in the profit expectations, what's in there and it's really interesting is an actual acceleration in revenue growth. And that is in contrast to the deceleration expected for nominal GDP, which just suggests that there is that disconnect where the economy is expected to slow, yet revenues are expected to go up at the same time that margins are expected to go to a new all-time high. I would say that the equity market is not pricing in any form of recession. 12% growth next year, another 10% growth in 2025. And that is where the disconnect is with the bond market, which if you're going to go over 75 basis points of cuts, you're effectively saying that there's a higher risk of recession. So it's a question of, does the equity market come down to the bond market or the bond market then come up to the equity market?
A lot of this needs to be reconciled. Andrew Sliman, I know you've got to go. It's great to catch up with you, buddy, as always. Cameron Dawson is going to stick with us. We'll get you an outlook for 2024 from Whaley of BlackRock in just a moment. Equity futures pulling back 1/3% on the S&P. Let's get you some movers. Here's Abby.
Ahead of taking a look at what is dragging on markets this morning, John, let's take a look at one leader. That is CVS. Shares are popping higher after the pharmaceutical healthcare company reiterated their 2023 guidance, offered 2024 guidance that apparently investors like. They also increased their quarterly dividend by nearly 10%. They're launching a new drug reimbursement system to simplify how they get paid. It could be industry changing. Investors liking all of it on a stock that's down 26% into today. Take-Two Interactive down 3.5%. The trailer for one of their popular Grand Theft Auto, the next version, 6 specifically, is positive, but it won't be out until 2025. They haven't given an exact release date, and some analysts are saying that could be a worry. And then finally, Coinbase down 1.3% as Bitcoin comes back to earth just a little bit. Well, it's bringing the crypto space with it, John.
Abby, thank you. More from Abigail around the open in Bell, about 18 minutes away. Equity futures down by 0.4% on the S&P. Coming up, gearing up for the year ahead.
It's going to take time before we get inflation under control. And I think that process, meaning into next year, still means that the downside risks to the outlook continues.
That's the view from Apollo. Coming up next, the view from BlackRock, their global outlook for 2024. An exclusive conversation with Chief Investment Strategist Wei Li up next.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's going to take time before we get inflation under control. And I think that process, meaning into next year, still means that the downside risks to the outlook continues. Risk is if people wake up suddenly in the next few quarters and say, wow, maybe there's more downside risk to consumption, because the hit is not only from interest rates going up. If people also start losing their jobs and the labor market soften, which is what the Fed has been talking about, we get the double whammy of both high interest rates hanging in there at the same time while the labor market finally softens.
That was Apollo's Thorsten Slog weighing in on the impact of higher for longer. BlackRock out with its 2024 outlook, recommending investors seize opportunities within the changing environment. Here's the quote from them. The new regime of greater macro and market volatility has resulted in a dispersion of returns. We believe an active approach to managing portfolios will carry greater rewards. A sea change from the one-and-done asset allocations that worked so well during the Great Moderation. That period is over, and it's time to seize opportunities the new regime has to offer. BlackRock's Wei Li joins us right now. Wei, let's talk about that new regime, that title, grabbing the wheel. Wei Li, what's changed?
Well, as we look ahead to 2024, as we think about outlook, context is everything. So earlier on, I heard multiple references to lending, and if you look at the economic activities more recently, compared to a normal expansion, it feels like a strong expansion. But if we zoom out, actually, we're still at pre-pandemic levels. So nothing is flying. There is no landing. We're just climbing out of a hole. And ultimately, what this means is that we don't need a recession as a result of that. But the bigger point is really that we're now in a different macro environment, an environment where we do want to put money to work, and it's even more important to do that. But the reward for being active is greater, for being selective is greater, which is how we're thinking about implementing the themes for 2024.
A part of your approach is to harness mega forces. There's 5 of them, 5 themes, I believe. One is AI. Of those forces, Wei Li, do you think the focus is going to be on things here in the United States? Does that dominance around that tech story continue?
We currently still have a overweight in the DM, tech, and AI megaforce, which has been a long-held overweight in our portfolio. As we think about opportunities in this particular megaforce, we have to think about the multiple stacks where AI can have an impact. You start from the semis and the chips to the foundational model, the data center infrastructure, as well as all the way to the third kind of stack around applications. So far, if we look at the performance of the Magnificent Seven, they almost doubled. So clearly, this theme has already played out very well, but we see future further stacks providing greater runway for this theme, which is why we're still overweight in this exposure, and earnings are coming through. And looking ahead to 2024, tech is expected to carry more than 50% of the earnings growth for next year. So certainly this is different from the dot-com bubble. We do think that there is more runway, which is why we're still overweight. And as we think about the broader U.S. equity allocation, whilst we have a underweight to the overall benchmark, the overweight in AI and tech actually takes us close to neutral allocation. And on top of that, you consider the greater alpha opportunities, selective opportunities in this environment versus the period after global financial crisis, where central banks were taking out a lot of macro uncertainty with their forward guidance. Now, the room for having differentiated view, the reward for that is greater, and the room for that is greater. So we certainly want to think about being more deliberate and selective as we think about investing in 2024.
Wei, you alluded to it just then. You're not exactly bulled up aggressively on U.S. equity markets. Just geographically, is it time to look outside of America after a period again of absolute dominance and exceptionalism?
Well, with the overall close to neutral allocation to U.S. equity market, including the AI allocation and potential alpha selectivity opportunity, we also see opportunities outside of the U.S. exactly as you say. So if you think about Japan, for example, which is a country that we have liked for most part of this year, we upgraded twice through the course of 2023, but we think that this has more room to run, but we like it on a currency unhedged basis as we think about the prospect of exiting from yield curve control. We also like, well, emerging market is interesting, and increasingly we get questions around emerging market ex-China. So here we look at countries like Mexico, countries like India that are actually benefiting from the cross currents of some of the mega forces that we have identified, including aging population, they have younger population, including digitalization trend. But of course, in these markets, valuation has run up, so we even want to be more selective within these exposures as well. But certainly, we want to think about pushing against the home bias tendency as we think about geographical as well diversification for 2024.
Wei Li, appreciate the update. Thanks for jumping in front of a camera to give us your outlook for 2024. Wei Li of BlackRock, Cameron Dawson and New Edge, just waiting patiently, listening to that. Cameron Dawson, that final line there, time to move away from the United States and look elsewhere and drop the home bias. What do you make of that?
Yeah, I mean, the allure of international markets has been persistent for years because they've traded at such a huge discount to the U.S., as well as underperforming so much on a historical basis. The challenge is that these markets have been value traps. They've been underperforming for nearly 15 years. The question is, what is the driver to get that underperformance to end? When we look back in history, the only time you have sustained major bull markets in international versus the U.S. is when you've had major dollar bear markets, which just means that a dollar call is absolutely critical to going overweight international markets. We are finding lots of opportunities, though, within international markets. Our international portfolio trades at half the multiple of the S&P 500, which just means that there are pockets for good quality names, but it's hyper selective in those markets because they remain in very distinct downtrends versus the U.S.
Cameron, BlackRock neutral U.S. equities, but within that neutral is a big overweight to that big theme, AI and big tech. Would you push against the leadership of big tech this year for next year in 2024?
I do wonder if, just as obvious as being underweight big tech was at the beginning of 2023 because of rising real interest rates, and of course we now know how that worked out as big tech was a big leader despite rising real interest rates, that the obviousness of crowding into big tech into 2024 could create the inverse scenario, which just means that if we look at positioning in tech, it's become very crowded, sentiment is quite ebullient, and we know that you've had a big uptick in expectations. These are still very great companies. It's just a much higher bar to jump over now that you have seen so much crowding into that space. So we still have an overweight to tech, but we're trying to be very careful and cautious with the idea that if you have already seen everybody get there effectively, does that just create too high of a bar to jump over, despite how good and great these companies are in a short-term period?
And just look at Meta and Nvidia year today, absolutely flying, huge repricing there. Cameron, good to catch up as always. Cameron Dawson there of New Edge. Your equity market at the moment, 7 minutes away from the opening bow, something like that. Equity futures negative by 0.4% on the S&P. Coming up the morning calls and later, JP Morgan's Jack Manley warning investors to contain their enthusiasm or risk getting burned. That conversation up shortly.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Or 5 minutes away from the opening bell, just adding to yesterday's losses, just a touch on the S&P, down by about 0.4%. That's the price action. Let's get you some morning calls. Your first one from Bank of America, downgrading UBS to neutral, seeing a challenging year due to mounting expenses. Your second call from Raymond James, downgrading Lulu to outperform, saying recent channel checks point to slowing growth in the fourth quarter. And finally, UBS downgrading United Rentals to neutral, expecting limited upside given the weakening macroeconomic landscape. That stock is down by almost 3%. Coming up, JP Morgan's Jack Manley making a case for bonds over stocks. That conversation just around the corner. Equity futures negative this morning. Your opening bell just around the corner.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
You have a large following on X, or what used to be called Twitter. Sure. Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
25 seconds away from the opening bout this morning. Good morning. Pulling back again, just a touch on the S&P. Yesterday, biggest one-day loss, biggest one-day drop in about a month on the S&P 500, taking some more weight off that rally in the previous month, just a little bit. We're down 1/3 on the S&P, down 0.5 on the Nasdaq 100. There's your opening bout. Switch on the board and get to the bond market yields. Back-to-back days of double-digit basis point moves on a 2-year. On what? Chairman Powell tried to push back a little bit on Friday, got rolled over, steamrolled in Friday's session. Monday on nothing. Yields up big time across the board this morning, down 4 on a 10-year, 4.2145. In the FX market, the euro showing some more weakness against the dollar, just about holding on to 108. 108.18 on that currency pair, negative by 0.2%. And crude, 73.40. We're up by about 40 cents, up by 0.5% this morning. About 30 seconds into the session, more losses for you, down about 1/3. No drama here on the Nasdaq with negative 0.4. One stock to watch at the open, AutoZone. The auto retailer reporting results that beat expectations. Abby has this one. Hey, Abby.
Hey, John, and investors are trying to figure this one out because the stock had been up as much as 1% just moments ago, now up about 0.3%. They did beat earnings. Same-store sales also showed growth of 3.4%. So investors basically cheering it, but revenue's flat, so that could be holding them back. But let's not just stop at AutoZone, because we also have company news on CVS. They did reiterate their 2023 guidance. They offered 2024 guidance that investors apparently liked. They raised the dividend by about 10%, and they also are changing how they get reimbursed for prescription drugs to simplify the system. Some experts are saying this could change the system for everybody. As for consumers, it's a mixed bag. Some drugs will be a higher price, some will be lower. CVS saying more will be lower. And then finally, sticking with healthcare, J.M. Smucker, kind of healthcare, they are saying that the weight loss drugs not affecting their results in a material way right now, apparently not affecting jelly demand. They did beat earnings by 5.7%. They cut the fiscal adjusted earnings just a little bit, but perhaps on the sales, profit, and volume beat, that stock is up 3.3%.
Good for the soul. Healthcare. Abby, thank you. James Smucker up by 3.3%. Let's turn to the autos. Check out Tesla. Struggling as strikes spread to Denmark. NIO moving higher as profitability tops estimates thanks to cost control measures. Ed across both stories this morning. Morning, Ed.
Good morning, Jonathan. Tesla basically flat as we're talking now, a little higher, up 0.4%. If it did fall today, it would be the 5th straight day of declines, which is the longest streak of declines since August. The story is a Danish union acting in solidarity with its Swedish counterparts. And the impact to Tesla is that the Danish union workers on docks are not loading vehicles or transporting them through to Sweden Sweden is Tesla's 5th biggest market in Europe, not 5th biggest overall, but 5th biggest in Europe. And as you know, Tesla has been holding out on signing a collective bargaining agreement with the unions in Sweden, collective bargaining a standard practice in that market. Elon Musk has called the Swedish union's approach insane. And as you know, Tesla has pushed back against union efforts in various markets. The story with NIO is they were down in pre-market. They gave a forecast for the current period where EV deliveries will come in pretty significantly below expectations and revenue will miss. But it's turned a corner. We're now higher 6% on the ADRs for NIO. The loss that NIO experienced, 4.6 billion yuan, which is $644 million US, narrower than expected. This is a company that has had recent job cuts, trying to rein in its spend. Like many before it, its ramp is proving costly in its pursuit of profit to bring EVs to new markets, not in America, but places like Europe and the Middle East.
And before you go, just on Tesla, we're talking about Sweden. Let's talk about the union effort here in America. Just how big is that for Tesla at the moment? Is it growing?
Yes, it is growing in sentiment, but Tesla has always pushed back and said, well, frankly, we're able to pay better than the legacy OEMs, and if you're a full-time employee rather than a contract-based assembly line worker, you have the incentive of stock compensation. That said, I've covered Tesla a few years now, John, and if you speak to current and former assembly line workers, many of them are booked through a third-party management company or work placement company, right? Temporary workers company who take a cut. So the number that they're given on an hourly basis is never as big as they say. It started in the first few weeks of the pandemic and Tesla shut it down pretty quickly in Fremont. It's not really had the traction thereafter. Will it happen now? Hard to say.
Open question. Ed, thank you, mate, for the update. Stock's doing okay, no drama. Tesla up by 0.3% this morning. Let's turn to gaming. Take-Two falling after the release of Grand Theft Auto 6, revealed to be in 2025. Isabel Lee has this one. Hey, Isabel.
Hey, John. So this is all because of a premature leak. So shares were falling around 3.5% during pre-market trading, and it's now pared back some of its losses, but still it's down by 2.5%. So the trailer was originally slated to be published around Tuesday morning at the time of your show, but then it was posted early. And so the company had to move up their timeline and also publish earlier. They posted it on YouTube, and X also suspended account on Twitter, or now X, who posted the game. So Rockstar Games, a subsidiary of Take-Two, published that trailer, and analysts saw the trailer as a positive. But still, the fact that it was being published in 2025 and the fact that there's no set release date is what's causing some disappointment. Now, why is this closely watched? Because Grand Theft Auto 6 is likely to impact Take-Two's revenue growth. So if you recall, the previous game, which is Grand Theft Auto 5, debuted in 2013, and it was the second best-selling video game in history, and it sold more than 190 million copies. So that's just behind Minecraft's 300 million copies. So this is why this space is closely watched, and investors and gamers are really looking at the game. And now we have shares still lower, though paring back some of its losses, but year to date, the stock is up around 50%, John.
Down about 1% this morning. Isabel, thanks for the update. Let's turn from gaming to streaming and take a look at Netflix. There's a call on the south side from UBS, reiterating its bullish view on the stock and writing this: management is focused on broadening its offering, deepening connection with fans and diversifying its revenue base, all while continuing to expand margins. The analyst maintaining its buy rating and a $500 price target. That stock is slightly lower this morning, down by 0.6%. I want to turn to some deal news. AT&T tapping Ericsson to modernize its US wireless network. Simone Foxman has this one. Hey, Simone.
Hey, John, this is a $14 billion deal. The money is going to be paid out over the course of 5 years, and this is to modernize AT&T's wireless network, especially preparing it for 5G. But it's actually part of a bigger shift called Open Radio Access Network technology. This allows AT&T to really rely on more vendors than just one, than just Ericsson, in parts of its infrastructure. This is a movement that really was catalyzed by the elimination domination of Huawei infrastructure over time. And so this is what Ericsson calls a strategic shift for AT&T. But what's good news for Ericsson, and we're seeing shares there rally over around about 2% in the ADRs, is bad news for Nokia. Nokia has about a third of AT&T's business. It had really wanted to win this contract, but instead it went to Ericsson, and therefore forced to delay plans to reach double-digit operating margins by up to 2 years. The CEO called this decision disappointing, and one analyst from Danske Bank actually said that this might open up the possibility for Nokia to be disbanded and a U.S. industrial player to come and take part of its business. Ericsson, though, has been slow to embrace this new Open RAN technology, so analysts see this as a good sign, and we're actually watching AT&T shares, which were roughly flat at the open, now move about 3.5% higher off the back of this news.
That's quite a call, Simone. Thanks for that. Nokia down by 5.7%. The broader market at the moment, 8 minutes into the session. If you want the update, we're negative by 0.3% on the S&P, down about 0.1% on the Nasdaq. Very small moves. Let's continue the outlook for 2024. JP Morgan's Jack Manley discussing his outlook for markets, writing this: higher for longer is the narrative unless something breaks in a big way. I still like bonds more than stocks, but either way, quality is important, and a more grounded expectation for the macro backdrop is required if you don't want to get burned in the next 6 months. Jack, I'm pleased to say, joins us right now. Jack, let's take it from the top, and good to catch up with you, mate, as always. Why bonds over stocks?
John, it feels like every morning I wake up and rate cuts have been pulled forward, right? And maybe we've added an additional rate cut at the end of the year for good measure. There is just too much, I guess, pessimism around the state of the U.S. economy, which translates into optimism about the trajectory of Fed policy in 2024. Now, of course, we know rates are going to move lower. It's been one of the only things the Fed has told us from the beginning of this hiking cycle. And so we know that there will be that duration trade that kicks in, particularly in the belly of the curve. But my concern lies mostly on the equity side of the equation. I think stocks have just rallied too much, too quickly. Volatility is almost non-existent. All of it is predicated on this idea that we're going to start to see rates move lower as soon as the first quarter, and they're going to move lower by a whole lot. I just don't see that happening in the absence of an enormous recession. And if we get an enormous recession, that is not good news for stocks. That's my issue right now, John.
So, Jack, given what's priced, do you think we require deep cuts just to validate recent gains?
I think if you're a very short-term investor, John, you probably do. I mean, you're going to have to lean your or hang your hat on this idea that we're getting 100, 125 basis points of cuts next year, starting as early as February or March, in order to justify what's happened to markets over the last, call it, 6 months. But I always approach this conversation from a long-term investor's perspective. And as you know, John, we've spoken about this in the past. I am a stock bull. I am a growth bull. I am a tech bull. And if you are owning growth names right now, you should be owning them for more than just the next 6 to 12 months. You're looking at 5, 10, 15 years of investment horizon. And if that's the case, this short-term noise, it doesn't really matter a whole lot. But if you're going to be checking your portfolio every single day, I think that's where things are going to start to feel a little bit more painful unless you do see those rate cuts materialize, as is what's currently being priced in.
Can we just elaborate on a little bit of that a little bit more? Jack, the relationship between the bond market and stocks. At the start of the year, my understanding of things was as follows, really simple. If yields go up, tech will struggle, and banks will do well. You can turn that upside down, Jack, because that has not been the story at all this year. Tech has ripped, banks have suffered. If you've got this call on bonds over equities going into next year, what's the relationship between bonds and stocks and the performance you'd expect to see beneath the surface?
Yeah, I'm looking at positive correlations once more, John. I mean, I don't think fixed income is going to do a very good job of providing you a negative correlation to the equity market, because the nature of the equity market has just fundamentally changed over the last 15, 20 years. U.S. stocks are growth-focused, they're tech-focused. Those are inherently more interest rate-sensitive instruments, which means that as rates move lower, borrowing costs for these very large, growthy companies decrease, and that net-net is good for long-term earning prospects. So my guess is that correlations are positive, stocks and bonds next year, but both things working in your favor, right? Just the potential for outperformance in bonds relative to stocks, I think, is pretty evident right now, given how much run-up we've already seen in equities so far.
Wei Li of BlackRock was on the program, Jack, in about, I don't know, the last 20 minutes or so, and she said that next year is the time to look away from the United States, look abroad, and drop the home bias. Would you take the other side of that?
Yeah, I think this year was the time to do that. I think last year was the time to do that. I think the year before that was the time to do that. You know, I have a hard time justifying a meaningful overweight to international, or call it ex-US equities, because too much attention is being paid to valuations, not enough attention being paid to everything else. Now, what I can do, John, is take a slightly longer-term view to this international story and think about it more in terms of secular trends that are emerging overseas, right? Superior demographics in the emerging world, particularly Asia, looking at India specifically as a place where a whole lot of growth is possible looking forward. Growth of luxury goods, renewable resources benefiting the European equity market. But these are longer-term plays. Short-term, there is just too much headline risk for these regions to justify tactical allocation. So kind of like with that growth bias in the U.S., John, if you're going to take an ex-U.S. allocation in your portfolio, you better be in it to win it for the long run, because short-term, we have seen time and time again, doesn't always play out the way that it's supposed to.
Jack, appreciate the update, buddy. Thank you, sir. Jack Manley, looking ahead to next year. Bonds over equities with a bias towards growth stocks. Just took a look at the DAX. On course to close at a record high today on the equity benchmark in Frankfurt, Germany. Up something like 18% year to date. That one happening quietly, just beneath the surface. 13 minutes into the session, equities look like this. We're negative 0.3 on the S&P, the Nasdaq down 0.1. Coming up, Apollo says it's getting harder to beat public markets.
Public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening.
That conversation up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg UK, your source podcast for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
The brilliant Apollo CEO Mark Rowan weighing in earlier, speaking to markets, political risk, and much more in between. Let's recap with Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. If you think about what Mark Rowan was saying, this idea that markets, public markets, are challenged, that it's certainly true for equities in a lot of ways, particularly because you've seen the IPO market been so dry and companies go public so late and a fewer number of public companies to begin with. But what Rowan is talking about here is not just the equity market. He's also talking about risks to the public fixed income market. Now, this is a risk that a lot of people have brought up, including Citadel's Ken Griffin. The more that activity moves to private markets, people trading the idea of liquidity for more yield in private markets, Rowan is arguing does not need to be a risky endeavor in and of itself. Now, what this really is also, John, is a shot across the bow to the banking system. You've had Mark Rowan himself really speak over months now about this idea that every dollar that moves out of the banking system reduces systemic risks. Remember, Apollo's money is not like a bank where we've seen deposit flight throughout the year from big regional banks. We've also seen Apollo instead take money from insurance companies, increasingly through high net worth channels and through fundraising from the likes of pensions and sovereign wealth funds. Now, is this a safer model? We are seeing the likes of Apollo and its rivals step up to partner with the banking system to provide more capital to the system. But really, whether this is less of a systemic risk is in the mind of regulators, certainly in the United States and around the world.
This is still really early days, Sonali. Do you see the banks and these asset managers working against each other or ultimately together?
So Apollo has this saying that they're not dancing in the streets in the wake of more bank regulation. They're dancing with the banks in response to what Jamie Dimon had said a couple months ago about the private equity folks really feeling the love out of more pain on the banks in terms of regulation. Remember, the bank CEOs take to Congress tomorrow. They're addressing the Senate on risks just like this. And I bet you they're going to be fighting back hard, John, against those new regulations. And they're going to be pointing to the Apollos of the world and saying, listen, that's where the money is moving now.
The financial landscape is changing quickly. Sonali, thank you for the update. Really enjoyed this morning with the team over at Apollo. About 20 minutes into the session, we are negative by 0.3% on the S&P 500. Tons of data out there. Mike McKee has some for you. Hey, Mike.
Good morning, John. Well, we've got sort of the opening act for data today. Coming up at 10, we have the ISM Services Index. Before that, the S&P Global Services Index, and it comes in matching what the preliminary number was, 50.8, but that is up from the October number, so it's an improvement in services that we're seeing from the S&P numbers. Their composite comes in the same as it was in the preliminary and in October, 50.7. Around the world, though, it's kind of interesting. We saw France, Germany, and the Eurozone still all negative in terms of services, suggesting contraction in those economies now, and there is much more talk of the ECB perhaps cutting rates sooner than the Fed. The one country to pat on the back, John, is yours.
There we go. Look at that.
It's supposed to be the sick man of Europe, or the European area, since they're not in Europe anymore, technically. And instead, they're seeing growth in services and the composite.
We're in Europe, Mike, just not in the European Union. That's the important piece of this. Mike, I want your thought on this quote here from Mohammed Al-Erin on Fed Speak. I do believe the Fed is done raising rates, but I don't think that validates what is in the markets about rate cuts next year. They still have a significant communication problem, and they still have a credibility problem. What would you say to that?
I think they have a slight communication problem because, remember, the markets are all over the place on every given day. But Jay Powell, when he spoke last Friday, said that the Fed basically was done. They were in extremely restrictive territory, but then he went on to say, we are not going to be cutting rates anytime soon. Didn't come out as strong as he had, so people took that and ran with it. But maybe they'd stop saying both things and just say, we're not cutting rates, we're leaving them where they are.
Selective hearing in the bond market, Mike. You and I have been talking about that over the last week or maybe the last decade or so. Might be key there. Let's get you some sector price action, how this session is developing. We're down by about 0.3% on the S&P. Abby has more.
Hey, John. Well, if the loss holds, it could be the first back-to-back decline for the S&P 500 going toward the end of October. It's a broad-based decline, even though it's on the smaller side. The two sectors up at this point, tech and communication services. To the downside, the rest of the universe, we have a number of sectors that are down more than 0.5%. The worst sector, materials, down 1.5%, the worst day since October. I should say the worst 2 days since October. Let's dig in just a little bit more, because something that makes this sector interesting on the day, John, you can really see that cliff dive down. All 29 members of the material sector are declining. It's not really clear what's behind it, but you could take this as a broader read on demand in the economy, and maybe it's slowing.
Abby, thank you. Up next on this program, we'll take another sneak peek of the calendar for the rest of this week in the trading diary, and I'll bring you the updated, the latest estimates in our payroll survey. Payrolls a few days away from New York City. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Minutes into the session, 2 days of losses for the week so far, at least early days. We'll see if this sticks. We're down 0.2% on the S&P. That's the price action. Here's the trading diary. The calendar stacking up as follows for the rest of this week. At the top of the hour, ISM services and JOLTS data coming up. On to Wednesday, US bank CEOs testifying before the Senate, plus the 4th GOP presidential debate. Thursday, got another round of jobless claims for you. And let's just sit on Friday. The payrolls report just around the corner. The estimate drifting a little bit higher as more estimates come in. The median estimate at the moment, 189. The previous read, 150. Unemployment, 3.9%. Wages, average hourly earnings, month over month, 0.3% is the estimate. The previous month, 0.2. This can change over the next couple of days as we get more estimates in our survey, but that's the latest median estimate for you. across the board. More still to come this week. From New York City, though, for me this morning, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there to kind of upside.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Brokers studio in New York City. To our worldwide audience, coming up, we're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, get his thoughts on this Federal Reserve. What is the next move? Are we getting rate cuts in 2024? Then we're going to check in with Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets, for a breakdown of how she sees these markets here from a macro perspective. C-suite conversation today with Phil Zhao, CFO at eCarx. He's going to join us to discuss the electric vehicle industry. They're a big player there, making lots of components for EVs. So we'll talk about the electric vehicle revolution. But first, let's kick things off with John Tucker.
All right, Paul, we are data dependent, so let's start right there. And this is an eye-opener. The JOLTS job opening survey coming in much lower than anticipated. So this is, we're going to call it Fed-friendly. Immediately, the reaction in the yield space, 2-year, which is more policy reactive, that was unchanged. It is now down 7 basis points, 456. Let's get to the data. 8,733,000 job openings in October, according to the JOLTS survey, much lower than anticipated. In the previous month, that was also revised lower. We told you the move in the yield space as far as equities go. In the early going, they were much lower, shaving some of those earlier losses. The NASDAQ 100 right now has turned higher. It is up 29 points. That is a rise of 0.2%. Earlier today, we interviewed Allianz Chief Economic Advisor, Bloomberg opinion columnist Mohamed El-Arian. He told us earlier the basis for the November melt-up in stocks and bonds basically was wrong.
I do believe that the Fed is done raising rates, but I don't think they will validate what's currently priced in by the markets in terms of rate cuts next year.
And the S&P 500 right now, that has just turned from red to green, only up a point, but still higher nonetheless, 45.70 on the index. Dow Jones Industrial Average, that is still lower, down 93 points, down 0.3%. So a bit of a surprise there on the data front. And again, Fed-friendly. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess, I'm so relieved to see you again. It means I don't have to talk as much. Jess and Paul.
We had a ball at 9 a.m. It was a lot of fun.
Yeah, thank you guys for covering. Jess Metten is sitting in for the next 3 hours because we have no idea where Matt Miller is. Something about paternity leave. I think he's taking care of
paternity leave, to be clear, not fraternity leave.
Yeah, that's right. It is paternity. He is working. He tells us he's working. So
Minister Menton is here.
Exactly. Thank you very much. Jess Metten, Paul Sweetie. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. We also had some ISM data come out, Jess.
Yes.
The services index came in better than expected, 52.7. The consensus was 52.3. So there's growth in the services part of the U.S. economy. That was up pretty materially from last month, 51.8. So
it's like business activity employment picked up.
Yes, exactly. And new services, new orders, 55.5. That was better than 54.9 consensus. So again, on the ISM services side of the economy, again, 70% of the U.S. economy is services, seeing a little bit of a pickup there. So good news in that. That's kind of opposite what we're seeing from manufacturing, still some manufacturing in contraction. So S&P kind of flat right now, up at 2 points. Let's see where the action is in the equity market. So we welcome Elena Popina. She is Bloomberg Equities reporter joining us here in our Bloomberg Interactive Broker Studio. Elena, what are you looking at?
Yeah, a couple of things, guys. Take-Two Interactive, the maker of video games, is down 4%. The company released the first trailer of its new super anticipated video game, Grand Theft Auto. Ooh. So it was first released in 1997, was a huge success. You know, all the fans are waiting for the new update, and they are not saying when exactly that's going to happen. So that disappointed investors. Shares are down 3%, 3.5% actually, because investors are looking for more certainty. So bad news for investors. I'm also looking at CVS, ticker CVS. It is up about 3% after the drugstore said it's changing the way its pharmacies are getting paid. So they are setting very clear terms for the cost of the drug, the fixed markup, and the fee for the services provided, which is good news for shareholders because they're going to get more clarity. Shares are up, and investors are kind of clearly cheering the news.
All right, well, here's my recommendation for CVS, V as in Victor Health Corp. Hire more people back in the pharmacy. The lines everywhere I go are like 6, 7, 8 deep, and they've got one person back there.
That's right.
Filling them, answering phones, doing everything. I mean, it's unbelievable.
They look so stressed out anytime I go.
And they're responsible for getting your medication correctly dosed. I'm
Right.
Like, I mean, it's scary sometimes going back there. Hire some more people.
Yeah, but finally they're going to get paid more, hopefully, and that's good news. And maybe they're going to have to hire more people at some point.
All right, I go to CVS like everybody else. So, all right, good news there. What else we got?
We're also looking at EV makers. Tesla is a big one. NIO is another one. The China-based EV maker NIO reported profitability that beat estimates across the board and better than expected adjusted earnings and vehicle gross margin. That's the good news. The bad news that investors aren't paying attention to is that the current quarter outlook, the fourth quarter outlook, is much worse than expected. Analysts are saying, let's wait and see. Maybe things are going to change in the next 3 weeks we have this year. They're very optimistic. That's a good thing. Shares are up about 5%.
Tesla, they have a strike in Denmark. Spreads to Denmark, halting shipments to Sweden. I mean, that's just on the Bloomberg News. I have no idea what that means for Tesla, but stock up again today.
Some analysts are saying that's part of the reason behind the weakness in Tesla today, because cars can get into Sweden, and Denmark is saying that we won't let cars in as well, just because we want to support our colleagues in Sweden. The dispute is about 130 to 150 workers in Sweden. That's not a lot, but there is a big issue, and it's been ongoing, and let's see what happens next.
And Bloomberg Intelligence is out with a note here. Tesla is entrenched as the fast charge leader, which complicates outlook for some of the competitors there. So that's another part of the business as well. So interesting.
Yeah.
Anything else?
That's it for me for now.
Right.
Pretty quiet.
Yeah, it is pretty quiet. We're waiting for the Fed. We got a lot of economic data this week.
Blackout week period for the Fed speakers.
Which is good. I mean, they should do that more often, I think. Don't you think that we hear from them too much? I mean, I don't know.
We have unemployment data later this week, and we have CPI and the FOMC decision next week. So it's going to be a pretty eventful couple of days and couple of weeks.
All right, so we'll have some economic data, not necessarily company-specific data. So we're pretty much done with the earnings. All right, Elena, thanks so much for joining us. Elena Pepino, she covers the equity markets for Bloomberg News, joining us here in our studio in the global HQ for Bloomberg. That is 731 Lexington Avenue, 58th Street. You know what I saw across the street going to the retail here? The retail store.
Tell us.
You know how with the pandemic, our headquarters, 58th and 59th on Lexington Avenue, all the retail was blown out. They all left their stores except for one little chocolate shop. And then Sephora is still there. But a lot of the retailers left. One of the big spaces across the street, they're renovating. It looks like somebody new's coming in.
Ooh.
So that's a good little tidbit for
Midtown.
real estate, retail, that kind of thing.
Midtown Manhattan.
News you can use here. A little bit of coming back here in Midtown East. We're kind of almost Upper East Side, actually.
Yeah, that's a good
when you think
point.
about it here at 60th Street. All right, let's go to Ira Jersey. He is not here in New York. He is in Princeton, safely ensconced in the Princeton HQ for Bloomberg Intelligence. Ira, we're going to hear from the Fed coming up soon here. You see some data here, like the JOLTS data came in today, well below kind of where people were looking for. Seems to be Fed friendly. How do you think the Fed is looking at some of this economic data that we've seen over the past several days and weeks?
Yeah, I think that the Fed is going to be, reasonably happy with the way that the economy is turning out right now. I mean, maybe not if we're in recession, but it does seem like, the data generally is slowing. But as you guys were just talking about, we do get some incredibly important data this week that will probably set the tone for the Fed at the meeting next week. So the payrolls data obviously is very important, but I think next week's CPI report that we get right before the Fed starts to meet is really going to be telling as to how hawkish or dovish maybe Jay Powell and the rest of the Fed speakers will be for the rest of the year.
Ira, I'm taking a look at the 10-year Treasury yield where it's trading right below 4.2 after crossing above 5 in the middle of October. So right now it's trading around its lowest level since early September. What do you make of the big move down we've seen since it crossed 5?
Yeah, well, it's just one heck of a rally. But, you know, the big changes that have really occurred is, remember, the reason we got the 5% on the 10-year yield was we had priced for the Fed to, instead of cutting interest rates to 3%, we only had, we repriced the Fed to only cut to 4%. So basically we priced out 100 basis points of interest rate cuts during the next cycle. Now we're starting to go the other way. So it just makes sense that 10-year yield has to follow the expectations for what the longer-term Fed outlook is, and that's exactly what's been going on over recent weeks. And with a slowing economy, you'd expect interest rates to be somewhat lower. You're also starting to see, you know, we focus a lot on the 10-year yield, which obviously is a benchmark for a lot of corporations and a lot of discounting that people do in their work. But the 2-year yield, which in a way is as much of a benchmark as 10s, that's come down all of 50 basis points as well, right? From 5.10 to 4.6%, where it is today. So I think that that's really the signal that, hey, the market thinks that the Fed is going to start cutting. Not necessarily as early as some people think, but nonetheless, you definitely are seeing that downshift and the idea that the Fed is going to be worried about and okay with the pace of inflation starting sometime next year.
And just let you know, the mortgage, the bankrate.com U.S. home mortgage 30-year fixed, 7.53%, down from a little over 8% just a few weeks ago. So still really high relative to what we've seen over the last 10 or 15 years, but coming down off its peak. Hey, Ira, what are the pros doing? What are the hedge funds doing in the Treasury market? I mean, I'd seen some news recently where maybe they were unwinding their short position. What are you seeing when you talk to some of your hedge fund clients?
Yeah, a bunch of things going on. So people have shifted from neutral to long treasuries, and you know, you look at some of the data and some of the people that I've talked to, and it seems like people are worried that the Federal Reserve is going to be cutting next year, and because of that, people are finally starting to buy duration. You look at the J.P. Morgan Active Treasury Investor Sentiment Survey, and that's almost as long as it's ever been. It's come off a little bit in the latest survey, but which was conducted last week, but the week before they were as long as they've ever been in history. So clearly people were looking for, you know, basically bargain hunting in the Treasury market and getting long. So it does seem like not only are people getting less short, but they're also getting long and being and getting into the rates market. And certainly the price action has showed you that too, right? You don't get a 75 basis point rally in 10s on people not buying.
I remember seeing a quote from Warren Buffett, you know, maybe a month or two ago, and he says, hey, every auction, we're going to be out there buying. And if the hedge funds want to sell them, we're buying them here in Omaha. And maybe it looks like, again, he was right.
Hey, Ira, you mentioned that some clients are worried about the Fed cutting interest rates next year. When you square that away with some of the resilient data that we've been seeing, we just had more service sector data this morning that Paul and I were talking about this morning, coming in stronger than expected. Does this suggest that the Fed would actually be able to cut borrowing costs if the economy still is showing signs of resiliency?
Well, I don't think so. So I'm differing my view on what the Fed's going to do a little bit from my economic outlook. So yes, the economy is slowing. The question is, will the economy be slow enough to drive inflation toward the Fed's 2% target? And the answer to that, I think, is no, not at this point. You can't say that. And like you said, service sector is still looking pretty strong. Goods sector, goods inflation might actually start to creep up a little bit over the next couple of months. So we're in a situation where you have probably stable-ish inflation near 3% and a slightly slowing economy. That's probably a situation where the Fed's going to be on hold for longer than what the market's currently pricing. We're now pricing for a couple of cuts by the middle of next year, and I think that gets priced out of the market. And when that happens, we will see a bit of volatility and a bit of adjustment in the rest of the Treasury market too. So you know, the Fed's still in inflation fighting mode, and I think that next week will be an opportunity for Jay Powell and the rest of the Fed to make it clear that they're still not happy with the pace of inflation.
Well, thanks to you and to Lisa Abramowitz, I actually, unfortunately, now do pay attention to Treasury auctions, Ira. Anything coming up that I need to focus on?
Well, we have, so we have next week the Treasury auctions, which, you know, 10s and 30s are going to be what we focus on. Last month, the 30-year was terrible. I mean, it was really not a good auction at all. So we're going to keep on focusing on those. But it is interesting because these auctions people are picking their spots. So even though we had a week, last week we had a weak 7-year auction, but we had a really good 5-year auction, right? So people just like 5s, don't like 7s. And I think that's just a dynamic that we'll continue to see when this new supply comes out.
Well, next week, as you're mentioning, the Fed decision on the 13th, what are you expecting as far as what the dot plots could be telling us? Because as you know, they do change every quarter, but I know investors are focused very heavily on that going into that meeting.
Yeah, so that'll be really interesting, and probably the market will take whatever changes occur in the dot plot as a signal for how the Fed's thinking about this. So right now, the Federal Reserve has some cuts priced in, but remember, in September, they had the year end that they were going to hike again, and that seems to be completely off the table at this point. So if the Federal Reserve were to, say, downshift and lower a few of the dots, so the median dot goes a bit lower for the end of next year, then you could probably see a bit more of a rally in the 10-year sector where you see yields approach 4%, whereas if they go the other way, then just the opposite will happen. So I think it's a pretty binary decision. I suspect that the base case has to be unchanged. I think maybe the dispersion, so the difference between the high and the low expectations maybe comes in a little bit for 2024, and in particular because, we just have more data. We now have, a little bit more consensus maybe on what's going to happen in terms of the economy for next year.
Ira, what's the top story in global soccer that I need to be focusing on?
Well, a couple of things. We have the MLS Cup final coming up this week, so that's super important. And Lionel Messi calling Major League Soccer a minor league in his hometown newspaper. So that was something that I think maybe it was taken a little out of context. He's just saying it's not one of the big 5, which it's not. So
right.
Not a big surprise.
All right. Ira Jersey, great stuff as always. Ira Jersey, he has our go-to person on all things on the rates. He's the chief U.S. interest rate strategist for Bloomberg Intelligence based in Princeton, New Jersey, and also our resident soccer guru on a global scale. You just can go with him for pretty much any question, any league, anywhere around the world. He knows it all. He's kind of like our Molly Smith, who is to tennis. Ira Jersey is to soccer. Molly Smith, Bloomberg News, is our tennis guru here at Bloomberg, and we go to her for all its stuff. S&P 500 off about 0.1%. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Shares of CVS Health, they are higher right now. They're up about 2.5%, and this after the drugstore chain delivered a sales outlook that beat expectations. The company also announced a new pharmacy reimbursement model. It's called CVS Cost Vantage, and it says it's going to bring greater transparency and simplicity to the system. It's expected to launch in 2025. While shares of AutoZone, they're fluctuating, and this is after reported results that beat expectations. Bloomberg's Abigail Doolittle has more on that.
They did beat earnings. Same-store sales also showed growth of 3.4%. So investors basically cheering it, but revenue's flat, so that could be holding them back.
Now that's down just a fraction right now. Ericsson beat Nokia to the punch after it landed a $14 billion contract with AT&T to modernize its wireless network over 5 years. Bloomberg's Simone Foxman says it's part of a bigger shift called Open Radio Access Network Technology.
This allows AT&T to really rely on more vendors than just one, than just Ericsson, in parts of its infrastructure. This is a movement that really was catalyzed by the elimination of Huawei infrastructure over time, and so this is what Ericsson calls a strategic shift for AT&T.
Ericsson's ADRs right now, they're up about 4%. AT&T is up about 2%, but Nokia's ADR is really taking a hit. They're down more than 5%. And Meta Platforms, IBM, leading an industry-wide coalition to share artificial intelligence technology. The tech giants joining more than 40 companies and organizations worldwide to form the AI Alliance. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is...
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It is the data that is driving markets right now. Yields are lower. The major stock averages, they have turned from lower to mixed right now. This comes after the JOLTS data showed fewer job openings in the U.S. economy. The previous month's reading that was also revised down. This is evidence the Fed's policy working to slow things down, to cool the rate of inflation. Maybe policymakers will have to actually start cutting their rates next year. In the S&P 500, consumer discretionary, information technology, and communication services, they are all higher right now. The S&P 500 just turning red to green, up less than a point, but still green, 45.69 at the index. The Dow Jones Industrial Average, 127 points lower, and the NASDAQ 100 is up 62 points now. That's a rise of 0.4%. The two-year yield space, 4 basis points lower. That's at 4.59. The 10-year down 7 basis points. That is at 4.18. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
There you go. Push the blue button. That's how it works. Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Radio. Boy, you go ECO Go on the Bloomberg terminal, EGO, and it gives you all the economic data that's coming out, over the coming days. And man, it's a busy week this week. Lots of stuff. Today we had the JOLTS come in a little lower than expected, so fewer job openings. ISM services, just as we were talking before, came in a little bit better than forecast, better than last month. That's good, maybe Fed friendly, but I don't know how to put all this together. Fortunately, we have smart people who know how to do that for us. One of them is Jennifer Lee. She's a senior economist and managing director at BMO Capital Markets. And for the folks, the kids that don't know, that's Bank of Montreal back in the day. BMO Capital Markets, a great firm up there in Canada. So, Jennifer, looking at the U.S. economy, what's your take here? I mean, is it a soft landing, a hard landing, a no landing? What's going on out there?
Good morning, and thank you very much, both of you, for having me on. I'm going to stick to what we have been saying for a long time now, which is that soft landing narrative. At least it is up until now. Like this morning's, as you were pointing out, this morning's two reports, the ISM was up and the JOLTS were down, job openings were down. So but it's not down enough. We still have over 1.4 jobs available for every unemployed American out there. So that's a pretty decent job market overall. We're not seeing, 2 jobs for every one person like we did, last year, but it's still a tight labor market and it's still fairly healthy. ISM services, showing that activity is picking up the most in a couple of months. I mean, this is only the first increase in a few months, but still it shows that, again, this whole soft landing narrative is still playing out, at least for now.
Looking at the ECFC function in the terminal, you can pull up looking at where the consensus among economists that are pulled in the terminal. You can look at annually, also quarterly. If you look over quarterly, though, on a basis, there no longer is a quarter-over-quarter contraction coming into this year. Originally, there was a call for the second and third quarter to see contraction. We aren't seeing that anymore. We're still seeing growth. So I'm curious your thoughts on when there still is this concern, because looking at how the consensus among economists, the probability of a recession is still around 50%. That's pretty elevated compared to if you're looking at, say, other firms like Goldman Sachs that have lowered their calls in recent months. Why do you think there is still so much skepticism and gloominess out there about the trajectory of the economy when you have this juxtaposed against a lot of really strong consumer spending data?
I think it's a great question, and I'm thinking that we've never been in this sort of environment where we have a central bank like the Fed that has been tightening so much in such a short amount of time. This is like a record amount, and yet we're still seeing business investment. It has its ups and downs, of course, but it's still supported by fiscal spending, and it all goes back to the U.S. consumer staying resilient. They're not going to be spending like crazy, in coming months. I think things have already started to dial down. But again, it's that job market. I think it all goes back to having a strong job market, and that goes back to demographics, It goes back to the pandemic. What I was a little bit worried about, I will say, was when I saw the personal income and spending data last week with that very small 0.1% wages and salary increase. And I was like, oh, that's not great. But, it's good in terms for the Fed, but it's not great for the consumer. But as long as, we continue to see steady job growth, continue to see steady wage gains, either 0.1 or 0.5 or whatever, I think that will be a good support system overall for the U.S. economy. Now, we actually polled, by the way, our negative growth rate quite a while ago, and I'm losing track of time here in my old age. But we have pulled it, and again, we're sticking to that soft landing. So we've got growth slowing from that unsustainable, I think, 5.2% growth rate in Q3 down to about 1% in Q4, and then flattening out a little bit around the 0.2s or so over the next first half of next year. But
Jennifer,
again,
Jennifer, talk to us about inflation here. I don't know. I mean, for John Tucker and I, it's all about filling up our cars with gasoline down at the Jersey Shore. And I just filled up for $3.10 a gallon. I feel like inflation's coming down, but I'm guessing the Fed doesn't gauge it on my gasoline intake here. But so how do you think the Fed is viewing inflation and the fight against inflation?
I think it's viewing it with a very cautious outlook. And even though, for example, like last week when Governor Waller introduced the whole concept of rate cuts into the whole conversation, which everyone got super excited about, he didn't, he just said that that was he was encouraged by that number. And it needs, I think he said 3, 4, 5 months before they can start talking about rate cuts. So he didn't even mention that they're going to start cutting rates. He says we need to see a few more months worth of better inflation data before we do anything. So I think they're viewing it with a very cautious outlook. But again, when we have longer term inflationary pressures out there, like from the labor market, we have the working age population globally has already basically peaked, right? So we're seeing a lot of people retiring, a lot of people shifting industries. So there's still that tightness in the labor market. And this is again, a global phenomenon, and certainly that in the US. I think Bloomberg ran a story this morning about nurses being, in short supply as another example of an industry that needs workers. So that's going to cause upward pressure on wages and the labor market. And then I'm going to point to Mother Nature again and climate. That's been causing so much havoc all over the world in terms of floods and droughts. And I think that's going to have, some still upward pressure on food prices and all that. And of course, all the wars are having upward pressure on energy prices. So all of that, I think, still has, I'm a bit worried still about inflation. I'm not going to call it an all clear just yet. And I think the Fed would probably agree.
On Friday's jobs report, we'll also get a reading on average hourly earnings. What are you seeing when it comes to wage growth? Because that is something that we know Fed Chair Jerome Powell is watching really closely.
Mm-hmm. So we're looking for about a 0.3 increase, which is in line with consensus, about 4% year over year. Still steady, but coming down. I mean, because we already know that the economy is slowing. It's not 5.2% anymore. It's probably closer to 1% this quarter. Demand is starting to slow. We're not seeing, 300,000 job increases anymore. So I think wage demands and the fact that inflation, as we just said, is coming down, I think is going to temper demand for earnings. Now, having said that, I'm also a bit concerned just given all the strikes that we've seen over the past year. And I don't remember a time when we saw so many and demands were being met. So that, again, is sort of like that, on the one hand, on the other hand thing, which I shouldn't be doing, but I'm doing it anyway. Overall, slowing demand for labor. But still, there's still that big source overall. So I think it's still going to be steady-ish, but slower wage growth overall.
Jennifer, outside of the U.S., where are you kind of focusing on? Where's the big delta? Is it Europe? Is it Asia? Outside the U.S., where are you focusing?
I'm kind of worried about Europe, frankly, but although this morning I will say that I was a little bit more relieved. It was and we normally don't look at revisions too much for services and composite PMIs because they usually don't change that much. But the fact that they all were revised higher, particularly in the UK as well, back over 50, was a little bit gratifying. And the fact that that last week's inflation rate for the euro area, the lowest in over 2 years actually, and the fact that one of the big Uber hawks herself, Isabel Schnabel, of the vice executive board member of the ECB, actually said that when things change, she changes her mind, and that's I think huge. Coming from her, some of the other hawks, from the Bundesbank, and we haven't heard from Austria recently, but I think they're still very more cautious on the outlook. But I'm still, again, worried about when the ECB will finally drop its hawkish talons. And of course, they still are surrounded by wars over there as well. So that's a little bit worrying. And of course, the UK is actually interesting. The data keep changing. You know, a lot of revisions out there that, you know, and we're seeing a lot of signs changing on growth rates, which is kind of interesting. But the UK is not looking as bad as I would have expected a year ago. So I'm a bit more encouraged on that front.
We only have about a minute left, but if you were able to ask Fed Chair Jerome Powell a question at his press conference next week following the Federal Reserve's decision, what would you ask him?
I would say, sir, with all due respect, assuming no one's in the room, just tell me what exactly is it going to take before you're going to start talking about rate cuts? What will it take? Like, tell me all the factors. I can put them on my little checklist and check them off.
What do you think should be on top of that list?
How many months of CPI do you need to, you know, and how much does it need to go down for the 3-month and the 6-month annualized rate before you can start saying, okay, forget it, we're done. We are completely, you know, complete at this point. And I want to see what he thinks about for wages as well on the demographic front. And, you know, and employment generally, you know, how much do you want the unemployment rate to rise by in order to say that you are finally finished?
Jennifer, thanks so much for joining us. Always appreciate getting a few minutes of your time. Jennifer Lee, she is a senior economist and a managing director at BMO Capital Markets up there in Canada. Always appreciate getting a few minutes of Jennifer's time here. And again, you know, the JOLTS data today came in. You know, we finally see, I think, well, I don't know, it's probably another data point, but the job market is still strong, but softening on the margin.
And then also we'll have the ADP employment report tomorrow ahead of obviously Friday's government report. So another thing investors will be watching on the labor front tomorrow.
Absolutely. S&P 500 pretty much unchanged here. The Dow off 0.3%. The NASDAQ up 0.3%. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Immerse.
All right, thank you, Paul. Israel is pushing its fight against Hamas further into southern Gaza. Strikes overnight hit the enclave's second largest city of Khan Yunis as the U.S. steps up pressure on Israel to limit civilian casualties. Bloomberg's Jody Schneider has more from Washington.
A spokesman from the Israel Defense Forces said last night that the ground offensive had expanded throughout the Gaza Strip, including hand-to-hand combat in some areas of the north. He had said it's going house to house, tunnel to tunnel, making no reference to Washington's admonitions about casualties, saying targets are based on precise intelligence.
Bloomberg's Jody Schneider reporting from the nation's capital. White House Special Climate Envoy John Kerry is calling out major oil producers for not doing enough to fight global warming, singling out Chevron in particular for failing to sign on to an agreement to slash methane emissions.
You can't be outside of this initiative. The evidence is overwhelming. There is no doubt about science. And that is why I say it is inexcusable. There's no reason to be permitting unabated efforts at this point.
Former Secretary of State John Kerry speaking at the Bloomberg Green Forum on the sidelines of the COP28 summit in Dubai. 6 other oil companies have provided $25 million each to a World Bank fund to help developing nations curb methane releases. CVS is changing how its pharmacists get paid with the launch of a new reimbursement model designed to simplify drug pricing for consumers. The approach aims to make the payment system more transparent by using a formula based on the cost of a drug, a fixed markup, and a fee that reflects the value of the pharmacy services. CVS will work with contracted pharmacy benefit managers and commercial payers to set the terms. CVS plans to launch the new model called Cost Vantage in 2025. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. More evidence that the labor market in the U.S. is cooling off. Job openings slumping in October to the lowest level since March of 2021. This sent the major stock averages from lower to mixed right now. And Treasury yields, they're declining. Traders lifting their bets of a Fed rate cut as early as March of next year. Meantime, after November's stock rally, Jay Woods at Freedom Capital Markets says a pullback, pretty normal, even healthy.
Yeah, there's a lot of, rotation into small caps, other sectors, and it's not the Mag 7 anymore. So you may not see the big indexes take off and explode to the upside in the near term. But long term, I still think we are on a path higher.
In the S&P 500, you have 8 of the 11 major industry groups. They're lower, 3 are higher. In the lead, consumer discretionary, information technology, and communication services. Biggest drag right now that is coming from materials stocks. The S&P 500 down only a point at 45.67 on the index. The NASDAQ 100 is up 52 points right now. That's a rise of 0.3%. And the Dow Jones Industrial Average 138 points lower. 2-year yield down 1 basis point now, 461. The 10-year yield 5 basis points lower. That is at 419. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Of course, Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. Jess, I bought a new car recently, a 2024 version, and it's the first new car I bought since 2014. And what I noticed is it's basically a technology platform with 4 wheels. It's software, it's point and click. It's basically your iPhone with 4 wheels. It's not so much about the car, is about the technology. And I'm wondering, who are these people behind all this stuff? Who
We're
does
about
all
to
this?
find out.
We're about to find out. Phil Zhao, he joins us. He's the CFO of eCarts, the NASDAQ-traded company. ECX is the ticker based in China. Phil, thanks so much for joining us here via Zoom here. Tell us, just give us the 30,000-foot view. What do you guys do at eCarX?
Thank you, Paul, for having me here. This is Phil. So eCarX actually is a pioneer in design and development and delivery of the best of breed of digital cockpit solution, as well as the full stack software solution and autonomous driving solution for electrified mobility era. So we are in this industry for 6 years already.
Who are typically your customers?
So we have multi-customers, both in China and outside of China. So in China, we serve for largest customer like Geely Group. At the same time, we also provide our service to Lotus, Volvo, Polestar, and Smart.
So one of my favorite features is the heads-up display. And it's like I'm flying an F-16. It tells me the speed limit and how fast I'm going and all that kind of stuff. I want to change the radio or the whatever, do anything on the entertainment front. It just comes right up on your screen. It's a little freaky, but again, it kind of makes me feel like I'm a fighter pilot or something.
Nice.
So Phil, talk to us about where your industry is going. It just seems like the technology is so extraordinary, making such leaps and bounds here. When I go to the Consumer Electronics Show in Vegas in January, it's basically an auto show, with some PCs around it. Talk to us about where the technology is going.
Yeah, sure. This industry is promising and got a lot of dramatic changes. So the e-vehicle industry already moved from the combustion engine focused to electrified mobility solution, move from the traditional vehicle to autonomous driving focused. So this industry is moving very fast, and now we are entering into an era that the electronic mobility solution with the vehicle solutions combination mode. So eCars is in the right position to support the industry transformation right now.
Talk to us about how the EV market is different in China versus the US.
Yeah, definitely. So China, the new EV market in China is booming. As we can see that we have many new players in the market, and right now, China players actually provide the best of the breed solutions in this industry, not only for the Chinese OEMs, but also they are going abroad. They are going to provide the services in the Euro market, in the US market, to support those global OEMs to grow and thrive.
So it's interesting here. I mean, we just think about all the technology here. Talk to us about your company a little bit. I see the stock down about 60% year to date. What's the story that you're telling your investors here?
Okay, so ECARX actually we are performing pretty well in terms of the financial performance. As we announced in quarter three, our top line revenue growth grew at 50% year over year, and our gross margin dollar also grew 140% year growth. All those strong financial performance indicate that we are in good shape. At the same time, right, for example, we provide our full stack solution to many vehicles. For example, we just support a Lincoln 08, the vehicle to launch in a year, right? We'll provide not only the computing platform, but also we'll provide, the ADAS solution, the autonomous driving control unit, as well as, the operating system called Flying Auto. So basically with that, we are able to increase the content per vehicle and increase our top line and profitability as well. So we are long-term focused company. We serve for the customer value. And right now, I would say that our stock price is undervalued, but it's okay. We are working on the customer value enhancement, and we do believe that the investors will see our performance recovery in terms of the stock price.
You talked about in your latest quarterly results about increased demand from international markets. Where have you seen the most increased demand?
So from an international market perspective, I do believe that many traditional OEMs, they would like to take into the new EV market. And that change had taken place largely both in Europe market and the China market. And lots of the global OEM, they would like to play in a big way in China market. So they want the partners like ECARX to support their battle plan in China as well. At the same time, lots of Chinese OEM would like to explore into their footprint in global market. And ECARX will also support those OEMs to thrive, to have the competition advantage in the global market. So that is what happened. We call the China to global and global to China.
Phil, how was some of the tensions between the U.S. and China, particularly as it relates to technology and technology transfers, how has that impacted your business?